Hi, I'm Kristen Savell, Executive Director of the Rock Center for Corporate Governance at Stanford. I want to thank everyone in the audience for joining us today to talk about good governance in the venture capital ecosystem. I also want to thank my fellow program organizers and sponsors, including Banu Ozkanek Pan, Professor of the Practice of Engineering and Director of the Venture Capital Inclusion Lab at the Nelson Center for Entrepreneurship at Brown University, and Dr. Johannes Lenhard, who is co-director of Venture ESG, as well as the NASDAQ Entrepreneurial Center and First Close Partners. I want to mention very briefly why we are putting on this conference today. It feels like every few years, a series of very high-profile governance and operational failures wreaks havoc on a large venture-backed company. Think Zenefits, Theranos, Uber, WeWork, and most recently, of course, FTX. When this happens, there's suddenly a lot of interest in what went wrong. And we hear about things like the problematic growth at all costs mentality in Silicon Valley, lax board oversight, unchecked founder power, toxic cultures, poor internal controls, and missteps in venture capital due diligence. For a while, it seems like everyone is talking about governance and why it matters and why this moment should be a wake-up call for startups and venture capital firms alike. But then the news cycle turns, momentum from social pressures wanes, and we're on to the next story. And without that public scrutiny, VC firms and portfolio companies are apt to return to business as usual, and we lose the opportunity for long-lasting, meaningful governance changes. And if the ecosystem doesn't start changing from within, I'm sure the SEC will be more than happy to fill that gap. In fact, the SEC has been looking to tighten its grip on private markets for the past few years and is now proposing to add regulations around how private investors vet deals, which is something we'll discuss in more detail later in the program. So our objective today is to keep the focus on governance beyond the latest news cycle and to share with the audience some tips and best practices that support good governance in the venture capital ecosystem. Hopefully, these tips can help prevent your VC firm from being the target of an SEC probe and your company from being the subject of the next made-for-TV movie about a startup that crashed and burned. All right, that sounded pretty ominous, but we actually have a great program lined up for you today. In just a few minutes, we will kick things off with a fireside chat with Miriam Rivera of Ulu Ventures. Our first panel will commence at 10:45 Pacific time, 1:45 Eastern time, and we'll focus on good governance at VC firms with a particular emphasis on portfolio due diligence, what qualifies as good due diligence, and whether the venture capital industry can embrace good due diligence practices without sacrificing return. At 11:45 Pacific time, 2:45 Eastern time, we will be joined by Ari Weinberg, Director of the Board Leadership Center at KPMG, who will share his insights on private company governance, as well as the findings from a recent survey on private company board practices. At 12 Pacific time, 3 Eastern time, we will kick off our second panel, which will focus on developing, implementing, and monitoring internal controls at portfolio companies. We'll finish up with some concluding remarks and a call to action. I want to turn things over now to Christian Bowles, Project Manager at the NASDAQ Entrepreneurial Center. Welcome, Christian.
Thanks so much, Kristen. My name is Christian Bowles, as Kristen said, and I'm here representing the NASDAQ Entrepreneurial Center as project manager of the Venture Equity Project, or VEP. We're a coalition of 10 nonprofits and academic institutions across the US and the UK, which are dedicated to finding ways to remove barriers to venture capital access for entrepreneurs and emerging managers of color. Unfortunately, over the project's 2-year lifespan so far, we've only seen that funding shrink as we drift further from the catalyzing effects of the Black Lives Matter movement. So as Kirsten touched on, we think it's more imperative than ever to react and find ways to ensure those sentiments last at a systemic level. Through research and analysis with our partners at Extend Ventures and Penn State University, we've discovered that many of the traditional excuses given by VCs for not funding or hiring people of color, like wrong geography, wrong industry, wrong education, wrong professional experience, actually account for less than 40% of the real funding gap were those entrepreneurs to be white. This makes racial and ethnic bias, better known as racism, the overwhelmingly likely explanation. And to address racism, we need to design better systems of accountability, hence good governance. And that's why we're so proud to work with the Rock and Nelson Centers to keep this conversation going at full tilt. We've witnessed an incredible coalition of people who just really care form around this issue. And we're confident that these next few years will be critical to the future of venture capital funding. If you have questions on how to get involved, please don't hesitate to contact me at the address that we'll provide in the post-event email. It'll also have other resources like a link to the Venture Equity Project podcast, which dives a lot deeper on these topics. So keep an eye out. And now, without further ado, I'm very happy to introduce the incredible Banu Özkazank-Pan, founder and director of the VC Inclusion Lab. Hey, Banu.
Thank you so much, Christian. Good morning, good afternoon, and good evening to everyone joining us from the US and all around the world. It's a pleasure to be so excited about governance, but here we are. It is my distinct pleasure today to be able to share a conversation with Miriam Rivera, who is a CEO, a co-founder, and managing director at Moon Ventures. Her name should be familiar to many of you for her various accomplishments. She has so many insights that we're going to be learning about today that it's my distinct pleasure to be able to have a fireside chat with you. What's amazing about Miriam is she's been in the industry and has a perspective that ranges for a few decades and has brought with her a wealth of insights and information, sharing with us the ways in which governance and missteps around it are taking shape in VC-backed and other sorts of firms. So it's my pleasure to be able to say hello, Miriam. Thank you for joining us. And we're going to jump right in if that's okay. I know we have some time today to discuss governance. I want to start with a big meaty question, which is around the fact that over the last few years, we've witnessed sort of these spectacular public collapses of several large VC-backed companies, including WeWork, Uber, FTX. What are, in your opinion, the most common governance missteps that you see at venture-backed companies? And are these common, or are these a few bad apples?
Generally, I would say that it's a few bad apples in the sense that very few companies are invested in so substantially and with such little oversight as some indications we've had recently. I will say that what I have seen in the Valley over time, though, is a real emphasis sometimes at kind of running and breaking things. I've literally heard some of the compliance officers at some of the larger firms saying that they don't want entrepreneurs to be thinking about regulation, that they want them to think about growing their businesses. Now, I think that would work if they actually had the experts in those areas still providing kind of what we used to call in Silicon Valley adult supervision at some of the companies. But it seems like a lot more of these companies are having less of that expertise available to them. And I think, there's a real challenge. There are definitely times when as a startup, you want to actually challenge existing law and or clarify areas of law that are not either friendly from the purpose of that law. Like, for example, if you think about copyright law, that was an area in which Google, where I worked, was a challenger because it wasn't clear what would happen to copyrighted materials as they were being made available on the internet. How can you do search if you actually don't copy an entire book? You couldn't find a place in a book where a consumer or a user wanted to access information. And that would be kind of like having a library without some of the pages in the books. And so, there are opportunities for challenging existing regulation and law, but hopefully consistent with the greater purpose of those laws.
Yeah, that's very helpful as sort of contextualizing what's happening. Just following up from that, do you think there's a role for LPs to play in terms of promoting good governance, both at the VC firm, but also at portfolio companies?
Yes, I think that LPs often have an ability to influence venture firms, right? Like we see that as they ask for diversity in their teams, that is having an impact on the diversity of teams at different firms. I think more it's creating smaller diverse firms, because I don't think that the larger firms are changing very quickly. But I think that it creates demand for a different kind of GP that is willing to work with LPs on things that they care about. And when it comes to governance, though, I think this is absolutely consistent with the expectations of LPs that venture funds and others are actually fiduciaries of their capital, and that that is an important role for the investments that they have. And they themselves obviously suffer financial risk, but it could be that they suffer reputational risk from the activities of their fund managers that are involved in companies that later turn out to be criminal enterprises.
Yeah, absolutely. And really sort of building on that, Miriam, why do we continue to see investors pouring money into VC-backed companies that demonstrate these really serious governance flaws?
I think it's because there's a tremendous opportunity in front of us as investors in terms of trying to create better ways of doing things. And that sometimes comes with risk. And that's a very common part of decision-making as investors. One of the things that's happened, and it's basically been since Google, we were one of the first companies to ever hit 1 billion users in the world. And if you think about it, in the history of humankind, there's only been a few organizations that have ever hit 1 billion users, anything, and they're called religions. And so one of the things that I think is happening is the market that's available for economic activity has never been larger, right? We have like 5 billion users on the internet now, a huge part of the world. So that makes the potential for trade greater than ever. And the changes that are happening at kind of the government level in terms of recognizing the ability of technology to provide for in real time globally is just glacial by comparison. So there is a certain amount of risk that I think is expected if we're going to actually provide the users in the real world better ways of doing things, and government is just having a really hard time keeping up with that transformation. And that is part of why governance is weak, is that it's just difficult to actually be in compliance when you're looking at regulation that essentially is global in nature, and where the limits of government versus free enterprise are.
Yeah, that's a great point. And we're lucky today that we actually will hear from panelists who are geographically located in different parts of the world, including Europe, where regulations and just the narrative around the role of government in investments is dramatically different. So I look forward to hearing from them as well. So we have this idea that fear of missing out, the sort of the aspirational returns that are possible may lead to poor decision-making around due diligence. When we think about the fact that there are these potential huge returns, but there's still maybe a duty for good due diligence, why do you think investors continue to ignore some of these, good practices around governance? Do you think it's sort of, there's a norm, it's normalized, this fear of missing out? Or do you think there's sort of a different ways in which decision-making happens that is based on years of experience and, a couple of bad investment decisions here and there, we still continue our way?
One, yes, I think fear of missing out drives a lot of behavior economically. And then two, I think the risk individually is so high that many partners at these firms don't want to be on these boards, just frankly, right? Like, we understand, we're at seed stage at Ulu. A lot of the times a board is frankly a nice to have, right? You can't fire and replace the CEO at the seed stage because they're the controlling shareholder in the company. Also, the idea may not have someone else that could actually make it work. And some of these factors apply to some of these super fast growing companies as well. And so that is something that I think influences whether or not people want to serve on these early stage boards. And I actually believe that a lot of the investors don't necessarily understand the technology, its capabilities. I don't think they understand the compliance requirements of organizations that engage in some of the activities like, blockchain or crypto, not really. And so it's difficult to serve on a board of a technology that you may not be as expert in as you would like to be. And you don't understand the regulatory environment as well as you would want to. And I think that's pretty typical for a lot of folks that don't want to actually undertake the personal risk of their own assets in serving on these boards.
And, we're getting some really great questions from the audience. I'm going to pop into those in a minute. I did want to sort of ask you about the idea that and you really sort of discussed this a little bit, but to delve a little bit deeper into the fact that why do we think that convincing founders that boards and board governance at an early stage is a good thing?
Well, fundamentally, it is the case that the founder bears tremendous personal risk in a startup, right? Like, in the more typical scenario in the state of California, for example, if you enter into the zone of insolvency, it's clear that you may end up having to pay, salaries and or vacation time out of your own pocket as a board member. So one is for founders, we always try to emphasize that for a lot of them, this is a new chapter of learning where they really would benefit from more experienced people and awareness of the different risks that a startup has and the different potential for personal cost. And obviously, in some of these cases, we're talking about criminal liability risk. That is something, and also, in different companies, life safety or other factors may be involved where having folks that have had more experience understanding these kinds of risks, what happens, how to make better decisions. I did both the law and the business school programs, and I think that really is helpful. Having the perspective of what other companies done when they've faced moral risk in their business, and you want to have a range of life experiences so that you have a set of trusted advisors that can guide you as you face real personal risk on both your economic life and your own liberty.
Yeah, and I think that's a valid point in terms of the personal risks that are associated with becoming a founder and becoming legally liable for some of the decisions that you're making. So that might be a conversation well worth around, like, what are the real risks versus the imagined in these sectors. I have another question, and then I'd love to sort of jump into some of the questions that are being shared here in the audience. One from Anne, which I will get to. Innovation is a really important topic. And a lot of times when we talk to investors, they are telling us that, we don't want regulation because governance and sort of the regulatory aspects might really impede our ability to innovate. So how can VCs optimize governance for innovation, right? In other words, how can governance become a tool for promoting and sustaining innovation?
Well, the way that I think about it is because you take informed risk, right? And I think many of us, whether we are serving on boards of startups or serving on a public company board, the conversation is about enterprise level risk, right? And what are the kinds of risks that should be undertaken by an organization in the achievement of its financial and other stakeholder related goals. And from my perspective, that's the conversation that really needs to be happening at any level of board. I do think that when you're when you're a startup company and you're working in new areas that are developing, you probably do need to bring in experts to work with you as either advisors to the business or potentially serving on boards, so that you really are building products that can be compliant in regulated industries like healthcare, insurance, even ed tech, for example, where you have privacy requirements that would prohibit certain kinds of information from being used by the company unless they have parental consent. So there's a lot of industries where I think we would benefit from having better board governance in venture capital. Venture capital has typically been focused on having boards that are predominantly other VCs. And I think that that's just a mistake. We don't allow public company governance to be done by folks that have such a narrow band of experience. And I think that on our own boards, we need to be looking for both diverse and informed governance by including experts in the industries that we are trying to disrupt.
Yeah, and I'm going to actually jump into Anne's question from our audience because it's very much related to what you just mentioned. And she's saying most of the due diligence and fiduciary failures I've seen have been when tech venture capitalists go into highly regulated industries like finance, insurance, or healthcare. Should they avoid these industries because they're out of their wheelhouse?
Absolutely not. I don't think that's the answer, because the disruption of these kinds of sectors tends to increase the well-being of the consumers of these kinds of services, right? Like, you know, healthcare and telehealth, for example, is a great example of how we're able to treat more people more effectively with less of a chance of contagion than if we're sending people to the hospital during COVID. So not investing in disruptive technologies is not the answer. I think the answer is really having expertise and bringing on expertise as required, and realizing that that's a cost of doing business in a regulated industry.
Yeah, and thank you for that. So absolutely stay in the game and continue with oversight, with education. I wanted to pivot to an area that's near and dear to my heart, and I know it's very, very important to you, and that's around DEI, inclusion, and investing in ways that ensure that our investments follow sort of the demographic shifts that are happening in this country and being globally competitive. So oftentimes governance, venture firms, we rarely address it in public. So I am really excited for you to be sharing with us in this sort of public forum. But one area where we have had some conversation is around DEI, diversity, equity, and inclusion, particularly after Me Too, Black Lives Matter, where we saw sort of an all-time high of conversations, and now we're seeing sort of a dip. In fact, 2022 was the year in which women received 1.9% of all VC funding, which is the lowest ever, despite an increase in number of deals and an increase in the pot of money available. So I was really interested in understanding, what have you found to be the most practical advice or best practices for really advancing the ball around the DEI conversation and practice?
I think from an LP perspective or from a GP into entrepreneurship perspective?
I think we would love to hear from both, because you have experience on both of those areas.
Okay, well, I'll talk to the LP side first, and then I'll talk a little bit in terms of the GPs. So some of the things that I've seen that are effective for LP organizations to be thinking about are, a lot of times their own policies are so restrictive that they really almost inhibit all investing in diverse folks. And so one of the things, for example, a lot of organizations have two policies in particular that I think they really need to look at and challenge. One of them is minimum fund size of 300 million or 500 million. By doing that, you're pretty much limiting a universe to a group of people that de facto is almost all white male-led organization. So trying to figure out how to increase diversity means that you may need to change these limits, and or you may need to change how you do business, where you have potentially hire consultants or have programs that identify talented people in smaller organizations that you can grow into your main investment activities and funds. The other thing is to look at potentially using funds of funds as a structure that a lot of people say, oh, we don't do funds of funds at all. And in a lot of ways, the funds of funds have increased the potential for organizations to access diversity. And your policies may, again, be essentially having the impact of prohibiting investment in diverse people. It's an interesting thing that I notice many organizations that are LP organizations have non-discrimination policies with respect to their staff, but not with respect to their managers. They'll have a different non-discrimination policy that allows discrimination for consultants and managers, but doesn't allow it for the people that are part of that foundation or part of that university. And I think that is in part because a lot of these old school policies that were designed to be racially segregated continue to actually apply. And people are unaware of unconsciously that they started to exclude and they continue to exclude, and that they have a differential impact on particular groups.
Yeah.
Side.
Yeah, no, thank you for that. I think it's really important that we understand the structures and making them visible, so we understand that even if we intend to do good, we may not be able to.
Yeah, and I think we need to find ways of actually getting diversity in there. And if you're having that hard a time, you might want to consider paying fund of funds fees, because it'll help you develop relationships with managers, understand who's out there in the marketplace, and then that may help you to develop a network that has some diversity in it from which you can source. Because I think that is, the value of networks is one of the most underappreciated by LPs. It's very difficult to source, not because there isn't diversity in the market, but because your networks are not diverse. And I'll give an example of an organization. When I was running Google Legal, we had one of the most diverse legal teams in the country. And I got a call from a friend who was working in the LinkedIn legal department. He goes, I don't know how you're doing it. How are you finding these diverse people? And I kind of laughed because LinkedIn has every lawyer's resume in America on it. So I didn't really understand the question almost but it was really about not the largest network, but who has a more actionable network. And if you don't have diversity in your own organization, you probably don't have a very actionable with respect to diversity. The same thing applies on the GP side in terms of investing in entrepreneurs. I think one of the great fallacies is that you can decide as a firm that has been in business for 20 years that if diversity is important, you're going to change it, and it's going to happen quickly. Diverse organizations where you have diverse people, when you think about it, people like myself have been part of diverse organizations in high school for women, for people of color, potentially for Latinx. We did the same thing at college. We did the same thing at graduate school. We did the same thing in our professions. So our networks are much more diverse and much more actionable, and it will take a lot of time and effort to invest in diverse networks of your own to get anywhere near the level of access. So again, it's not about, it's about developing networks for your GP. It's about your entrepreneurs also hiring diverse people so they have a different range of talent from which you can source.
Yeah, and kind of building on that, I'm going to sort of take from an audience member who says, could you also build on diversity of thought and approach? For example, introvert, extrovert, different educational experiences or educational levels and experiences, and socioeconomic status. So we can sort of expand this idea of diversity. What are your thoughts on that?
I certainly think that you want to have diversity of thought and experience, right? Like on our team, we have people that have worked in tech. We have people that have worked in investment banking. We have people that have worked in venture in early stage, late stage. We have people that have MBAs, CFAs, law degree, engineering degrees. Frankly, I think those are just table stakes in the world of investing in technology. But then in terms of, can you access 70% of the talent that exists in this country that is in female bodies or in other gender bodies? It's also in the case of people of color, immigrants. That is actually what's missing from way more of the organizations that invest capital or in the startups that are funded in this country. We tend to have quite a bit of that diversity of thought and experience on in most of the investment groups that I'm aware of.
Yeah, and that's an excellent point, is that it is out there, those people, those bodies are available. And how do you make sure they're part of your network or part of a network that you can access, whether you want to or not is another question, the intentionality. And I think you raise an important point around the fact that diversity and inclusion are a little bit of different animals here, because diversity, we are seeing more and more folks talk about it, but we're also seeing some folks sort of clustered in parts of the organization without really moving into decision making and powerful positions within firms, including in the VC environment. I have another great question from an anonymous attendee this time, and I really wanted to make sure that that was acknowledged. It's a question around whether from a founder or company perspective, what policies would you consider foundational to good governance? In other words, what should investors look for to feel confident in the existing governance structures prior to investment, privacy policies, terms of use, codes of conduct, non-discrimination, et cetera?
I think that those are a normal part of the diligence that many VCs do on companies. Now, I think that at our stage, they often don't have they are not using counsel sufficiently, and that they often need support to access resources to make sure that they have those kinds of just, again, I think of those as like table stakes of just being a business, and that that is part of what should come out in the diligence process with companies. And then, you kind of work with them to get up to speed on those areas. And that is one reason why sometimes it's helpful to have a board, just because, maybe taking time out of your day as a startup founder and having a meeting that has deliverables, that has a structure, may be more helpful to make sure you pay attention to the things that you need to pay attention in, both in just the day-to-day of running a business, but then also in terms of strategic issues. And I think, I do think that a lot of the times investors are focused only on one level here, and that is on us in terms of responsibility and being good fiduciaries of our capital that LPs are providing us.
Yeah, I have one final question as we transition to our first panel, and that really sort of is a question about how do we build that next generation of investors who not only represent the changing demographics of this country, but the new innovations and opportunities. So as we're thinking about talent management, that's become a really important topic. What are some things that firms, particularly VC firms, as well as LPs, should be doing right now to manage and support their talent and to prepare for investor succession? So what foundation should we be leaving so that our legacy is better tomorrow than it is today?
When we were thinking about our own legacy at Ulu Ventures, one of the things that we did in trying to bring in our next generation partners was to look at building a supportive environment and a cohort that would allow them to succeed. And I had a mentee through the Kauffman Fellows Program who wrote a paper that where she said, "I'm done being the only." And I realized that as a maybe an older woman, I had gotten used to sometimes being the only, and I needed to create an environment where the younger people were not still having that experience of being the only. And so we specifically hired a recruiter to try to develop a cohort hire so that there would be multiple people of color, multiple younger people, multiple women, multiple perspectives that were coming in that could support one another in the process of becoming partners in the firm. So I think we had also done our homework. We provided that recruiter with over a couple hundred different names of diverse people in the industry that we had gleaned from industry organizations that were targeting diverse communities. So, there's a kind of hand-in-hand work that you have to do with a recruiter to actually make sure that you have diverse people being considered for the positions. And I think that really has been very helpful to our approach.
Yeah, Miriam, I'm so appreciative of your insights today, and it's wonderful to see that not only are you able to share insights on good governance, but you're practicing those at Ulu Ventures and all the other organizations in which you are part of. So thank you so much today for sharing your wisdom, your insights, and some of the things that you're doing at Ulu Ventures for the Ulupreneurs. I think I'm pronouncing that right, the Ulupreneurs. And I, encourage everyone to sort of look up Ulu Ventures and some of the ways they're building relationship-based investment opportunities in various different founders and diverse founders. So thank you so much, Miriam. I'm going to introduce my co-organizer and colleague, Johannes Lenhard, who will now take over and be a facilitator and moderator for panel 1 discussion. Johannes is the co-director of Venture ESG, and he is a faculty and lecturer at University of Cambridge. He has co-authored several books. The latest one is forthcoming from Columbia University, and it's titled The Ethics of Venture Capital Investors. So we're very honored to have you moderate panel 1 today, and I will step off and let you take over. And thank you so much again, Miriam.
Yeah, thanks so much for making the introduction, Kristen, and thank you, Banu, for bringing us on the road. We have a packed agenda today, and we have a packed panel 1, 5 people, and what I think are 2 of the most important perspectives represented for this conversation, and one that is often overlooked, almost overrepresented, with 2 LPs on the call. I'm very, very happy to be joined by Suzanne Tavel and Teresa Badubitsky. Suzanne coming to us from Stepstone. I never know where you are, but I think in a different part of the world every time we speak. And Teresa coming from Germany to us. I thought it was very important to also have a European perspective in what is often a completely overrepresented Americanized discourse. So 2 LPs that we'll hear from their perspective on what is mostly going to be panel 1's conversation around VC behavior and due diligence from the very top, which is where I see the LPs, down to portfolio companies. And then I'm joined by 3 venture capital investors, all of you mostly practicing in the US, which for this particular conversation is great. First and foremost, Gillian Williams here, who I actually interviewed for the book ages ago in New York when you were still at your old firm, Anthemis, and now joining us from Cowboy Ventures, Seed Stage Fund. Then Scott Leonard, I also don't know where you are, but I think in LA, which brings a bit of diversity of location to this conversation.
I'm in LA, we operate globally, yeah.
From DFJ Frontier, as well as Touchdown Ventures, and then last but not least, Morgan Cheatham from Bessemer Venture Partners. I imagine either New York or San Francisco.
New York it is.
Perfect, great. I'm very much looking forward to the hour or so that we'll spend together. Again, mostly focused on talking about due diligence and the processes that have to do with governance, both on the venture capital level as well as on the portfolio level. And then panel 2 is going to be focused really very much on the company level, which then Kristen at the moment will actually moderate. Let's start at the beginning. We've had a couple of these company names already, but I wanted to bring some of these examples up that, Kristen said it in her introduction as well. We've been seeing some implosions or explosions over the last years in these tech companies. I will not mention Theranos. I know that many of you excuse themselves by saying there was not a single venture capital investor in there, which is not exactly true, but almost true. So I'm always very unhappy when the New Yorker writes a piece about Theranos, and I'm like, oh, all of the VCs are going to weasel around it, and because they had nothing to do with it. You don't have the same excuses for something like WeWork or FTX. Arguably, the failures that we've seen there were governance linked, at least. And let's start talking about that. How and why did failures like that or others, right, slightly less high profile companies, how did that happen? What has been going wrong? And perhaps let's actually hand over to Suzanne and Theresa to begin with and hear from the LPs before, again, opening it up. I'll try and distribute speaking time as much as possible, but always feel free to jump in. And I'll also, the audience, have a look at the Q&A whenever you want to ask questions. Please drop them.
Thanks, Johannes. Happy to kick off. So, I mean, for those of us who've been doing investments for a while, unfortunately, as has been noted, these type of events do come along with irregularity. I certainly started my career watching the LTCM explosion, implosion. And I think while no two collapses are ever the same, they certainly do rhyme. And one thing that I think we can all agree on is that growth and hypergrowth is extremely, extremely hard. We see certain patterns, which indicate that increased risk. Firstly, where the business basically outgrows its skeleton. So, what are the first things that businesses often outgrow? The people. There's often no HR. There's often no compliance. And one of the areas that they often outgrow quite quickly is the founder. And that's a very, very tricky situation. Obviously, some of the examples that you've highlighted, were very founder component was extremely material. I think the other issue one notes with hypergrowth is that businesses often divert from their core and expand to maintain the growth, right? And that brings on a whole unique set of challenges. And I think finally, you can have an external shock. So COVID, currency crises, etc. These are shocks which can exacerbate potentially an already weakened higher risk situation. So, and I think often what we note as well is that hypergrowth occurs, and as that is occurring, that is often correlated with lower levels of due diligence. As Miriam highlighted before, more people want to get on that bus. So just at the moment, potentially where the businesses need more help, more guidance, more assertive input from boards, you are actually having a more challenged environment around oversight. So a couple of observations from myself.
From my side, I absolutely agree with you, Susan. But I would like to add another factor, and this is the human factor. As VC is a high risk asset class. Not only that we invest or that VC investors invest in disruptive, innovative business models that can fail, but we also look for founders that are extraordinary, that are the maniacs. We look for combinations of founders that are going the extra mile, that are able to pivot, that are able to hyperscale in a very short time. And if you look out for these kind of founders, that might go well in 95% of the cases or even less, but you might have some rotten eggs in the basket from time to time where these maniacs go wrong. they are maybe too creative to think outside of the box. They are maybe too creative when it comes to looking for ways to bring their capital to the other side of the table. And I think this is one risk. A business case or business plan can fail, but also the team and the people can fail. And I think the upside and the downside potential is really high in these kind of founder stereotypes in which VCs tend to invest in. I think it's sometimes you can't recognize it from the very beginning, but sometimes you also need to be a bit more skeptical if people are super good in selling things too fast, too good, too everything is too positive. Then you also should ask yourself sometimes a little bit more, okay, is it really good in the long run? And I think the second point is when investors and shareholders are not really able to have grip on the company or to oversee everything. It's not only in the due diligence there, of course, you can check some policies, you can check the general structure of companies, but in these stages there is often really nothing on the table you can actually check. But it's your duty in the holding period to really have an active ownership in place and to talk on a regular basis with the founders wherever you can. And when it feels wrong, to have a proper conversation. If it's possible from your shareholding part, that's another thing. But you definitely have a fiduciary ownership or a fiduciary duty to have these kind of developments, to examine these kind of developments on a regular basis.
Well, I'd like to amplify that point because, Miriam talked about this in her talk, and she said, venture capitalists don't really want to be on boards anymore. And so we say, where is the fiduciary, the governance failure? The board role is the one where you have the opportunity, you're not driving the car, but at least you're in the car with the entrepreneur, figuring out where are we going and is there a chance to course correct? And if you're not in that boardroom and you don't have that role, how do you exercise those controls over a startup? And I think that, the trend is very much away in the industry from serving on boards. And I don't think it's because we can't, but because venture capitalists don't want to be in those roles anymore. I started in the business in the early 90s, and, there was never a deal that we didn't, serve on the board of the startup. And now I think that you look and you say there's this swing towards, I think, a need to be popular with the entrepreneurs, that, the words founder friendly are important to every venture capitalist. And so you say, if I'm sitting in a chair where I might potentially fire you, it's going to create a strain in the relationship. And so I think a lot of VCs say, it's not worth the trouble. I don't want to be unpopular. Serving in the boardroom is a pain. It's a lot of extra work. Why do it? I'll influence the entrepreneur from the outside. And, and then I think we could talk through some of these specific examples that you named, Johannes. But there's a long-term trend away from even seeking out these types of governance roles because of the, fear of being founder unfriendly and the desire to chase the deals that are the power law deals that, provide all the return. So I think there's a structural problem in the industry that actually leans us away from seeking governance positions.
Yeah, I think there's obviously certain types of funds that, you would have on one extreme of Tiger, who's full proposition was just we're going to give you capital, then back away and have fun. And then there's other types of funds that want more, actively want to be involved. And so honestly, how I think about it is the structure does need to start early on, because a lot of that precedent is really set in the earlier rounds, whether or not that board is formed, whether even in the legal docs, a lot of that is just kind of carried through. And so often, and also ownership is a lot harder to get the later and later funds are investing. And so oftentimes, even though a dollar amount that a fund can be investing is extremely large, their ownership can be really small. And so for a fund to be investing $50 million, but own 5% of a company or something like that, even though the dollar amount may seem large, for them to really then push and say like, I need a board seat when maybe you haven't had a board before, or to do something like that, really just doesn't work in that capacity. And so you really have to kind of have that dynamic set from the beginning and really have that culture set. And I think especially in the last few years, I think to Scott's point, where just like the culture was like, let's be founder friendly, let's also get deals done as quickly as possible, do anything to win the deal. It was just kind of like, okay, founder can get whatever they want. And so oftentimes a lot of that governance just kind of like went to the wayside for the worse. And so I think, you're seeing that in like, obviously the extremes that you mentioned, but also in just like the way that a lot of like layoffs are even being managed and things like in the communications being managed as well. And so I think you're kind of seeing now where people are trying to kind of rectify that a little bit more.
Completely agree with what's been said. And maybe just to add, if we all agree that great companies are built in all markets, we can also agree that governance failures occur in all markets. But I think we'd be remiss not to acknowledge that the environment we've been investing in for the last 15 or so years has been one where money's been very cheap. There's been a lot of venture capital dollars flowing into the ecosystem, not only in the form of funds, very traditional institutional funds growing AUM, but also a flurry of capital formation in terms of new funds being created. And that's kind of, that process of capital formation has transitioned a lot of the style of investing that we're talking about from one of, diligence, price setting, right, versus price taking, to one of momentum investing, which is, to Scott's point, let me jump into the deal that I think is going to have a power law-like outcome, and I'll let the rest kind of, work out for itself. Or using these kind of cheap heuristics, like a fund with a good name investing to pile into something, and that's certainly a strategy that's worked for certain managers, but it's not one that kind of stands the test of time. And so I think a lot of these failures that we've seen over the last 5 years that have been particularly kind of newsworthy flameouts are also related to just the free flowing availability of capital that we've seen. And I'm cautiously optimistic, as someone who's only been in venture for about 6 years. So again, I started my career in a bull market. I'm cautiously optimistic that as kind of the capital available kind of normalizes, that we kind of get back to the fundamentals from a diligence perspective, from a board work perspective, and a governance perspective.
Morgan, I think you made an interesting point there about, sort of, are we trying to build companies that stand the test of time, which I think, for a lot of us in venture capital, we were trained that way. I remember the very first deal that I worked on, I got to help with the S1, and we took this company public, and it was an independent public company for almost 2 decades. Profitable, it was a good outcome for the era. It would have, we'd look and say it was small now. It was like, $1.5 billion outcome. And that was what my first boss in venture capital taught me, is we're trying to do these deals where the LPs should want to hold on to the stock forever because the company is a good company that, keeps on growing. And I think, are we trying to make a quick buck, which in a lot of ways you could say is the job of venture capitalists, buy low, sell high as fast as you can? Or are we really building things that stand the test of time?
We'll return to that in a second. And I think that puts your finger, Scott, onto something that's very important, which both Suzanne's and Theresa's comments made me think of. Systematically speaking, there isn't really a need in this industry for good governance, because you are judged by the moment you exit. And that is not usually when the company is sustainably set up for generations to come, right? That's why actually many of the VCs I interviewed in the European ecosystem were very happy with Deliveroo. I mean, they would have been even happier had somebody thought about ESG, and some of the public market investors wouldn't have not invested based on the lack of ESG considerations that were integrated at the IPO moment, but they still made enormous amount of money. So from this power law perspective, whatever went wrong at Deliveroo didn't actually impact the VCs so much, because they exited sufficiently. It's the problem now, basically, right? And to Jillian's point, starting early is much easier, right? Changing a culture once Adam Newman has built it is very complicated. So I think we're also going to struggle with that in a case like WeWork. But let's go back to what even we should be doing now. And we'll touch on how the market environment has changing a little bit, to your point, Morgan, as well, going in a different direction from very cheap money in a bull market. What does good due diligence even look like when it comes to specifically looking at good governance, right? In the events that we run at Venture ESG, we're trying to educate and raise awareness and bring experts in to talk about different subsectors of ESG. And Banu and Miriam touched on DI. That was one of the first things that we've been talking about. The environment comes up more and more, carbon accounting, how do I even do that? The G has always been one of the things that we didn't focus on enough. So I'm very curious to hear from you guys on the investment side to begin with. What is it even that good governance would look like? And what do you look for when you're looking down at the companies? Trillian, Scott, Morgan, to jump in.
I'm happy to kick things off, and I'll let the other panelists join in. But I think diligence is an art, not a science. It looks different for every company. I spend actually all my time in healthcare and life sciences, which are highly regulated industries. Happy to talk about where we've seen governance failures in our sector, because they have not just an impact on business, but on patients' lives. And so this is paramount to us as healthcare investors. So, I think the typical process, right, is really, it all starts with a conversation between the investor and the founder, CEO. And I think a lot of times that conversation is rushed to get to the metrics, to get to the numbers, to get to the data. And funny enough, seeing how these processes evolve over time, I think a lot of the numerical analysis, depending on the stage of the company, is actually a great asynchronous exercise. And I really, in investment, we really try to spend as much time with the founder, just getting to know them. What are their motivations? Are they sales-led? Are they product-led, right? What are the examples of when they've shown resiliency? And obviously this is through getting to know them, but also the references we conduct. Importantly, references are both on sheet and off sheet. So you call the people they don't tell you about that maybe they've worked with, and that can tell you a lot. From a business diligence perspective, I think the way that the data room is crafted, again, this depends on stage, but if you're looking at a company that's revenue generating or has data, even the way that narrative is told, how granular it is, right? Does it look like everything in the Excel is hard coded, or are they giving you something that is kind of traceable, that kind of has a ground truth to it? So I think we look for a lot of these kinds of dynamics. And then I'd say, blocking and tackling on talking to customers, these are things that were customary prior to this recent, the last few years where we were mostly momentum investing, but talking to customers, understanding why they purchased a product. Do they plan to expand with the company? So that obviously, tells a lot to us about how they're forecasting and whether it's actually a realistic view of the health of the business. And then the last thing, I credit some of my mentors at Bessemer for sharing this, but we also ask for things like the historical board decks, right? So if a company is telling you one thing and you get access to the historical board decks and it says something completely different, well, that poses a great topic of conversation to understand what the delta is between the narrative and what's been documented at the company prior. And then maybe the last thing I'll throw in before opening it up is VC is a relationship business. And so actually speaking with the board members at the company, the existing investors, that's one of the most important parts of any diligence process. And hopefully if you're talking with folks that you have a relationship with prior or trust, they're going to give you a realistic perspective on the relative strengths and areas of development for the business. So that's kind of the higher order way we think about it, but there's a lot of other ways.
Morgan, I was going to mention that last one too, if you didn't get to it, which I'm amazed at the number of times that I've written the first check in a business and the next investor doesn't call me to find out what I think of the entrepreneur and the company. And you'd say, well, is there an assumption that I'm going to lie to them and just say great things about it and it's going to be a useless conversation? This is a relationship business. Many of us know each other for long periods of times. How can you not make that call and kind of look into my eyes and play poker with me and figure out if I'm telling you the truth about whether this is a good deal or not? And I certainly do that. I want to talk to all the people who backed the entrepreneur before, as well as who backed the person now. How is it really going? Am I getting into something that's going to be a mess? And that's a basic diligence to have those conversations, and people don't want to do it. And I think there's part of it. You had said something earlier, Teresa, that I think is really relevant too, which is what is the type of entrepreneur that we're seeking? And I did meet Elizabeth Holmes, and Tim Draper introduced me to her because DFJ had funded that company. I have some firsthand knowledge of it, and Tim very much is public about the philosophy that says we're looking for entrepreneurs who might get up to the moon or blow up trying. And I think in the business model that says we want these outrageous multiples, you do orient towards these very risky entrepreneurs. And, every firm has a different style. And it might be one where you say, I want more mature entrepreneurs who've done it before, who might be more open to governance. And I think there are lots of other investors, and there's enough capital in the system that a big chunk of the market goes after people and says, well, I'm just going to, hitch a ride with you and hope that it works out. And if you're one of 50 companies in my portfolio and it doesn't, I'm just going to back away. And I think that creates, risk for even the opportunity to have governance.
Yeah, I think somewhat similar to Morgan is like I focus heavily on fintech, so there's definitely the like regulatory compliance standpoint that we definitely have to focus on. And I think there's sometimes where like people will try to kind of like skirt that, and like that's something that like we do not take lightly whatsoever. And so like that will automatically be a founder that like we probably do not want to be investing into. But also something that we focus on quite a bit, especially because like at Cowboy, we invest so early, is really thinking about like what is the culture of the team that you're trying to build, and what does that look like, and really trying to understand from the founder of like what they want their company to look like. And like obviously that can matter from like the diversity standpoint, but also like broader than that, like what is the ethos that you want to bring into the values of this team. And really getting a layer deeper into that is something that's really important to us as well. And so obviously there's like, it's a little bit more of an art than a science to really be able to understand like what that is, what that means, if they're going to be able to execute on that. And also like if they're kind of telling you the truth on that or telling you what you want to hear. But I think that is also really important as well.
I mean, obviously this is a self-selected group of people who are more serious about, all of these types of issues. I think, to the question of, what does good diligence look like? First and foremost, it's don't get pushed around, right? It's be willing to do the work. And, when someone says, here's a hot deal, you have 48 hours to decide, the answer has to be, no, I'm going to do my work. And that, that requires a resistance to FOMO that I think is not necessarily prevalent across the industry. And there's no licensing body in venture capital. So there's no professional standards to adhere to, or really even formal training. So I think it's a real challenge.
Yeah, I always call that the unprofessional nature of the venture capital industry.
I mean, there's zero other industries where you serve as a professional fiduciary for somebody where you don't have licensing or continuing education or, any formal oversight. We managed to skirt that completely in venture.
I mean, unless you have to raise capital again, handing over to the two LPs, how do you make sure that this is in place, right? And this is not just the pitch that you get, right? Is there particular documents you look for, processes? How do you check on the GPs that are talking to you in the fundraising process that good governance is adhered to in the form that we just described?
Yeah, maybe I start here. I mean, we as KfW Capital, we are a state-owned investor. So our due diligence on our fund is super intense. So we actually look for everything. We not only checking our co-investors, doing KYC on everything. We check all the legal structures, the structure of the fund, who has stakes in the manco, who has ownership, who is in the position to decide where the money goes to, but also about the team itself. So who is it? Oh, how is the team managed? Who is sitting on the board? Who are the GPs? What is the track record here and there? How do they promote people from the junior to the senior levels? So all these kind of things are checked. We do thousands of reference calls to founders, to co-investors, to whatever. So I think from our side, we really do a proper due diligence on the whole fund, on the structure, and on the team spirit, on the type of people sitting in these in the VCs, because it's actually a marriage for 10 + 1 + 1 year we are having here, and therefore you should be really, really aware of who are you marrying here. Yeah, I think from our side, this is very, very intense, but also this is more the focus of our investment team. But when I step in as sustainability manager, I also review the investment process of the funds itself. So saying, okay, what are you looking at when you're doing your ESG due diligence? If you do your ESG due diligence already, are you checking governance issues? Are you checking the most material governance issues for your stage, for your level of industry, or for your product type? do you have any checks? Do you take ownership when you are invested? These are these kind of discussions we have with each of our GPs, and if it's not in place yet, they have to at least set up a decent framework which makes us feel comfortable. Yeah, I mean, this is actually everything we can do. Of course, there's still a risk that things go wrong, but at least from this point of view, I would say we do a lot.
I think we to add to that, you know, I mean, obviously Stepstone has been deploying through venture quite extensively, and obviously we purchased Greenspring, which of course is a very big investor across venture. And I think, you know, one of the things that we see is the value of time in terms of the relationships that we have across the market globally. And it's just as VCs are building the relationship with their founders, so we look to build the relationship with the GPs, really to develop an understanding of not the GP themselves, but even the layer under, which partners work well with what deals, what type of businesses you know, are these partners and their teams particularly successful in. And, you know, I think, you know, that sort of level of granularity, seeing how it extends over time, we find is extremely important. I want to pick up though on something that Teresa said, which is, you know, we embed ESG due diligence in as part and parcel of all the investment work that we do. And I think it's really interesting what the GP themselves is willing to hold themselves to, because often it then in turn reflects what they're prepared to work and enforce with their portfolio companies. So it has to be said that, I mean, we invest across private markets as a whole, and certainly within that, private equity, you know, relatively has been a laggard, I would argue, around ESG. And within private equity, venture is most definitely the laggard. So if we see like over 80% of private equity GPs, for example, have ESG policies at the moment, it is fractional of what's going on in the venture community. And I think this, you know, and often the argument that we get is it's not relevant to ourselves and to the type of businesses that we invest in. And I think, you know, across the ownership chain, from LPs down, that expectation definitely does, you know, need to continue to shift. It's only going to shift, you know, as a collective, right? What we're excited by is that we see some rather prominent, well-respected GPs in the venture space taking that shift and recognizing that ESG adoption, ESG leadership is value additive to their underlying companies, and very much is going to be key to the continued success of their business and their underlying investments. I think as we see more and more leadership being taken across the venture industry, clearly the work that Johannes and Venture ESG does, the work that PRI together with their venture initiative does, is critical to driving a shift across the space. Because clearly things like governance, things like a focus on climate, things like a focus on DEI are as relevant to venture as they are to other parts of private markets.
Yeah, thank you for raising this point about ESG. I think we'll take that now before we're looking a little bit into the future and actually very much into the present, as the SEC is likely working at the very moment about certain venture rules. But let's briefly talk about ESG and perhaps handing over to everyone on the VC side in the US to begin with. So Teresa and I have been working for a while now because the European ecosystem is, as some Americans would say, at least a year, if not two, ahead when it comes to VC and ESG, which has to do with a push through regulation. And again, we'll talk a little bit about SEC in a second, but VCs will have to disclose, and this is obviously only one part of ESG, down to portfolio company level across a number of reasonably onerous ESG, or what they call sustainable finance regulation, this year. So that's why venture ESG started about 2 years ago, as the European ecosystem was waking up to the fact that they will have to get ready for this, because the regulation was made years ago with a starting date and with the disclosure this year. The conversations we've been having in the US were a little slower. So I wanted to ask you guys, Gillian, Scott, Morgan, how has ESG featured in conversations and practices? Do you have an ESG part in your investment memo? Which is one of the things that Teresa would look at in her due diligence, from my understanding, right? Does it come up? Or, and this is also something I've heard from many LPs in the US ecosystem, are you taking a more piecemeal approach? Oh yeah, we've been doing DEI things for years, and now there's a big thing on the agenda that has to do with carbon accounting, but we don't actually talk about or touch or practice anything that I would call comprehensive ESG. What are you seeing? What are you doing?
Candidly, we are not doing anything at the moment. Like we do not have an ESG policy in-house. And I'd say honestly, like our LPs have not, I think for our last fundraise, it was probably like a check the box question as to whether or not we had something. And I think and like that was about it. But I'd say honestly, good or bad, even though we have like a pretty diverse group of LPs, even on the institutional side. And like, that's something that we value as a fund across the board. But like, even on like the broader DEI side, like we don't get many questions, if any, really about it. It's more so like we bring that up and we bring that up as a value, but like, we don't get that necessarily from LPs or any push on any of that.
You also, have a pretty diverse firm baked in.
Yeah, exactly.
How do you guys, gals talk about it internally? Because there's
I mean, like especially from a diversity side, like I'd say like our portfolio, I want to say is like 40%, and I think it's like 30% people of color, 45% women. And that's none of that is on purpose. It's just like we have a diverse team. So like that's how it kind of ends up working. But it's also something that we go back and forth on, and like how much we broadcast it and even push, because like to your point, like we've just hired one guy on our team. So we are predominantly female venture fund. And so we already are kind of toying with the fact that like most of the time when people see us, they're just like, oh, you guys probably only invest into women. You probably only invest into X, Y, and Z, like into consumer deals or something like that. And so like, we actually kind of go the opposite route where we're like, we don't need to talk about that stuff because we kind of already get put into a little bit of a box anyway. So we kind of want to kind of step away from it.
I think that's an interesting trend, right? So Phenomenal Ventures launched yesterday. And, Helen and Mina, it's a, female, women of color led firm. And they were very clear. It's like, that is not exactly what we're going to do. It's a $6 million fund and we've got to make money so we can raise our next fund. And so there's this, but you have your natural networks. And they said, our natural networks are led by, startups that are mostly white men, and we might be funding some of them.
Exactly.
We're probably most different out of the three of us. I don't know, Morgan, do you want to go? And I'll talk about corporate venture because I think it lends a different angle of attack on the problem.
Yeah, I'm happy to share. So I think at Bessemer broadly, when we think about ESG, we are a fairly roadmap-driven firm, meaning most of our investments are based on theses we've been developing over the last few years. And I think that's true for a lot of funds, but we tie our strategy very closely to these roadmaps. And so, since my time at the firm, I've seen our roadmaps evolve to bend more towards ESG principles. So we have a climate tech practice now. We're actively investing in climate technologies. That was not the case maybe 5 years ago. We invested in clean tech in like a different era when it was branded as such, but really a reinvestment and refocus on what technologies are going to drive transformative impact from an ESG perspective. I can say in healthcare, a lot of the stuff we invest in touches on the S part, the social. In the last few years, there's been a broad discourse around health equity. And so we've made a number of investments that really touch into this. One is a company called Folx Health. It's spelled FOLX, that's focused on primary care services for the LGBTQ community, starting with folks who identify as transgender, who are widely discriminated against and underserved in the kind of canonical healthcare system. Another example of a company that touches on the S is called Ansible Health, which is really focused on providing scalable chronic care management for folks largely in rural settings who may not be tech literate, who may need special support to really access virtual care, maybe different than the way that the folks who are all on this Zoom today might need. So those are some of the ways that I think our investment strategy is evolving, but I think it's an ongoing discussion at the firm as to what it looks like over time. Maybe I'll just add one other thought on this, the topic that you all were discussing earlier, which was really around positioning yourself as a fund that's focused on DE&I versus just kind of embodying it. I think, as someone who's a person of color investing, one of the biggest challenges I've had is people may be making assumptions that for some reason the returns are going to be different. Like investing in underrepresented founders is not, it's not charitable work, it's investing. And so, as someone who is a person of color, who invests in other people of color and other underserved groups, like I also maybe empathize with this kind of tension of whether or not to, be as outspoken or just kind of walk the walk, because I never want to imply that I made an investment that I think is going to have a differential return profile because of who the founding team is. That would never, be the case. So
we kind of know that returns will be different, and to all likelihood they'll be better.
Right. All the evidence is they'll be better,
which is great, right? And that is one of the frustrations that I have now, having spent years thinking about DI and how to push it into this ecosystem. The evidence doesn't matter too much, partly because of what we discussed today, right? This is very relationship driven, and we actually don't really crunch numbers or look at models or push Excels back and forth, right? Meaning data actually doesn't play an enormous amount of role in how investors and LPs to a certain extent seemingly take decisions. More so even here in the US than in Europe, from my understanding, because the fiduciary duty argument would go in exactly one direction, which is, as an LP, I enforce more diversity on your GP level because I know that that's yielding better financial returns. And we are far from that, right? Again, for the reasons that we discussed.
Bar is so low we could trip over it.
Right. Scott, did you also want to talk a little?
Well, yeah, on the DEI side, our approach has been fix our own firm first. I think it's easier to invest in entrepreneurs that are diverse if your firm is diverse. My firm, Touchdown, was founded by 3 white guys. So he was like, we got to work hard to do this because there was a, natural momentum towards hiring more people who look like us that were in our network. And I think it's a lot. I think it's very hard. I think we've done okay. We're, trying to continue to do better. And we put a lot of effort into it. On the ESG side, which I think, includes that subset of DEI, our model is a little bit different. So we run corporate venture capital programs where rather than pooling their capital into our fund, each corporation has its own fund. So think of them as the sole LP in their own fund, plus co-GPs with us. They're bringing the knowledge of their business, and we're bringing the deep networks in venture capital and the skill set of how to do that repeatedly at scale and according to best practices. And a lot of these are companies that you've heard of, like Kellogg's or Olympus or Avery Dennison. And then there's some are very large public or private companies where if you're not in that industry, you wouldn't have heard of it. Number 95 on the Fortune 500 is an agricultural co-op. And most of these companies have some sort of ESG directive that's fundamental to the core business that they operate in. So in that way, it actually is like what you described, Morgan, because if it's farming and we're looking at what's the role of carbon in the farming world, and how do we capture carbon and how do we think about monetizing it, and sort of what's the role of that with farms, it's natural to what that fund does. And so, I think with Avery Dennison as an example, probably the last 4 investments that we made had some sort of ESG, circular economy, recycling component, something that was related to sustainability. And that lines up with what the CEO of Avery Dennison has told Wall Street about what the company's going to do. So we look for those, we look for corporations that want to have funds where there's the opportunity to make money with venture capital investments that also do things that are, sustainable for the planet. And, we're trying to build our practice where every time we add a new corporation or a new fund and add to our team, it's attractive to the venture investors who want to make those types of deals. And so in a way that's not unnatural.
One introduction very quickly, just to not put this in front of 100 people in a way that might be confusing. Both Morgan and you, Scott, you talked about what some people call ESG investing, which, I mean, you get where I'm going in a second. That doesn't exist, in my opinion. What we can call this is impact investing, and that's where you have an outcome-driven business that, say, is doing carbon capture. And the bigger the business grows, the more carbon it captures, the higher the positive environmental, in this case, impact is. And more funds obviously have launched, especially E-focused funds, partly because that's the easiest to measure. And I think the industry is also the furthest developed since the first crashes that we saw about 20 years ago by Kleiner Perkins. And differentiating that very, very, very strictly, analytically speaking, from ESG is one of the starting points that I think we need to do. And that's why we're talking about one of the aspects today, right? Governance. I'm sure there are some governance investments that you could make in the sense that you just talked about, but it's the least of the three buckets that lends itself for impact, so to speak. It's very process driven, right? And if you ask me for a definition that is differentiating the two, ESG is about internal processes and impact is about external outcomes. And also ESG is for everyone, every VC fund in this world, every startup in this world, every public company is, by the way, already ESG rated. And we go to the Q&A questions. There's something about that there in a second. While impact is going to remain niche even going forward, I think that's important to differentiate that. You wanted to jump in as well?
Yeah, no, I totally agree. And I think it's a really, really important point. And it's an area that we see most conflated in venture, because as Morgan highlighted, so many of the businesses that you will invest in have massive impact. And therein lies the opportunity, because we're concerned that impact, to get effective impact, to really change real world outcomes, it needs to sit on a foundation of good ESG practices. So, let's take your healthcare business. You clearly want to embed processes in there that ensures a good equity of outcomes across all types of people, right? That actually has to start with the business itself being more diverse. That in turn has to start with your organization having thought around diverse management of its own people. So, it runs through the whole gamut. And I would definitely say that for us, this is an issue that we work a lot with venture groups to go, you've got great ideas around the impact, but we need to backfill and work to establish ESG processes within your own business. So clearly, and we see this a lot with groups investing around climate, that themselves, the GP has never conducted a carbon footprint on their own operations. It is a really interesting process to do that yourselves before you're telling other businesses how to go and implement.
Fully agree. We start with what we call cleaning up your own house in the trainings we do. So internal fund management for the VC fund, right? But last question from me before we're going to go into the plenty of ideas that the audience had here. And we already touched a little bit on this. Going from today into the future and thinking again, especially about good governance, how do we think, and I want to hear from all of you for this, good governance is becoming more enforced. It's already a much bigger topic of conversations, right? We're running 2 events on the G of ESG in this month alone with VC and only VCs. But what is going to happen in your perspective? Who's going to enforce it? How? And then especially for the Americans, what are we expecting from the SEC doing here, right? I always, to myself, explain the different kinds of regulation that are happening, where Europe is trying to cover all the different corners of the world, and regulate everything until people push back, and then they need to take a little bit away of what they've been doing, while the US just sits there, sues a couple of people, and hopes that that's enough of a symbolic intervention that nobody else behaves in the same quote unquote bad way. What are we expecting from the SEC, and how is that going to move the market in one direction or the other? Also, given that, and Morgan, you described this before, money isn't as available anymore. Actually, many people sit an enormous amount of dry powder, but it isn't floating into the ecosystem as quickly and as much at the moment. So the complete FOMO-driven, everything has to go quick isn't exactly the case at the moment, right? So all of that, considering right now, what are we going to see when it comes to good government enforcement going forward? Whoever wants to start from the 5 here.
And I can jump in. I mean, I think my thought with the SEC generally is it usually takes something to go pretty wrong for them to step in and make a decision. So like that's basically how I think about them, is that like something has to go pretty wrong and affect numbers of usually like end consumers for them to really start to regulate something. I also think, especially if we think more about like stepping back in like a broader definition of ESG and some of the other regulatory bodies that can influence it, there's also obviously the political aspect and like who is even going to be president in like a year from now. And that has a big influence on what that can potentially mean as well. So I think there's like a number of things that can kind of play into this. And then I think in terms of governance, I mean, I think in the short term, with sort of what's been happening in the tech ecosystem and sort of the pain that a lot of companies are seeing, I think a lot of companies are understanding the value of having more governance and having their VCs involved a lot more. So I think at least in the short term, you're going to, and also VCs are kind of having to get more involved because like they don't want to see their dollars go to zero. So you're seeing it kind of from both sides that like that activity is happening a lot more. Will that kind of stay as like the next bull run happens? I mean, you hope that people kind of learn and it maybe skews more towards yes, but obviously no, people never really learn from the past as well as they should. But I do think that I think some level of governance is always going to kind of like can continue. And I think you'll constantly always see like new models of venture that are more so just like free flowing capital.
I hate to say it, I'm pretty pessimistic about how any form of government or enforcement is going to play into this market. I think the numbers are down this year, but as you said, Johannes, there's tons of capital still in the system. I think you'd have to take another 3/4 of the capital out of the system before there would be enough of a squeeze. And I think limited partners would have to be much tougher on VCs, for real change to happen in terms of governance approaches. I don't think the SEC is going to do anything. I think we have a pretty strong lobby in venture capital to say, leave us alone and let us do our thing as an industry. And I think that, it's couched under the notion of we need innovation, let us move fast and break things. And I think the reason we're all having this conversation is sometimes you move fast and break things and people get hurt. Actually, we shouldn't do that. And, and then they say, but innovation and but profits and all this other stuff. And I think there needs to be a trade-off. And sometimes we need to accept someone looks over your shoulder and slows you down before you do something that hurts people. But I think your point is 100% correct, Jillian, which is unless massive amounts of consumers, that would be the equivalent of what happens in a, retail brokerage fund are getting hurt, they're probably going to let this, smaller-ish industry continue skating under the radar. And I think it would take political willpower. I think it would take multiple types of pressure to change that. And I think this question of, who's going to be president and who's going to be running Congress, and, could you pass anything over the objections of our industry's whining? I don't think it's going to change very fast. I think we have to do it ourselves.
I mean, it's interesting to see, obviously, within Europe, good governance has been backed into the focus on environmental and social outcomes. And obviously, any GP that wants to sell into Europe, is going to have to line up with the regulation there, and particularly the disclosure regulation there. And that is going to be an interesting dynamic, to watch groups, perform under the SFDR legislation, and how groups can manage to provide disclosure of this level there and in other jurisdictions not. So I think for particularly, I think we will see a number of groups actively decide whether or not to sell now into Europe because of that. I think the other point I would flag is, the push around regulation that we see globally is so much around climate. And I think if we're going to see any regulation come out of the US, I think it's going to have that orientation first.
The only thing I'd add here is, I won't pretend to know or be able to pontificate about what the SEC is going to do, but I think there's an entire generation of investors who have never seen this environment, who are, one, being humbled by how hard it is to generate returns in a sustainable way. And that not every deal you do gets marked up in 6 months at a 3x step up and rides off into the sunset. So I think that this moment, though painful for investors and frankly, founders, companies, and staff, is going to educate an entire generation that, to Jillian's point, hopefully we have a little bit of memory of this moment in the decades to come. I'm skeptical, but I think it's a really important kind of learning opportunity for all of us who are in this ecosystem.
For Europe, I would be a bit more optimistic because yes, on the one hand, we have a stronger regulation, and especially under this disclosure regulation, SFDR funds that classify themselves as impact fund have to do a good governance test on their investments. And as we know, our funds, for now, this is only mandatory for SFDR Article 9 funds or so-called impact funds, but funds like to compete and want to be the best one in their peer group. And I've watching this for 2 years now in the general space of ESG, where when I started doing this job at KfW Capital and conducting my ESG due diligence, there were a lot of funds with pretty poor frameworks, and now there are more and more funds with already come to our due diligence and have an amazing framework, and only a few ones don't have anything at all. The majority is somewhere in the middle, and I guess the more this disclosure regulation steps in and the more funds start to doing these good governance tests or general more detailed ESG due diligence processes, the more it will trickle down in the ecosystem and jump over to other VCs that are maybe not impact VCs. And on the other hand, also the ESG reporting may draw more attention to these kind of topics. And even though most of the KPIs, or rather on the E and on the S side, also some of the G factors are covered and are somehow interrelated, and therefore I think in general the attention towards those topics will rise, at least in Europe, and as more and more LPs will request these kind of data and will ask for the data, and the funds in Europe will not be able to fundraise anymore without providing these data to the LPs. So I'm slightly confident that this will change over the next 3-4 years.
Yeah, thank you so much for the outlook. I want to address at least 2 or 3 questions slightly more quickly from the audience here. Let's briefly take Luis Abulu's question here. When entrepreneurs have their pick of which investors to take money from, why wouldn't they pick the more lenient capital? right? And that is a very, very good question. What are we going to do if there's always going to be the guy who doesn't care about any of this, who writes the check in whatever a day? Is that changing? Are you already seeing that change? Or is that always going to be the way out? And what is going to catch that?
I mean, I think one thing I can say is that typically the person who's going to kind of give you the money and very, very easily is also just like not going to be that helpful on your cap table either. So that's kind of the trade-off that you have to choose, is if you just want capital and that's all you really care about, then great, that's fine. But you're probably not going to get the like easiest capital and then also like the most useful VC that can like help you with introductions, help you with hiring, et cetera, and being like a thoughtful partner to you versus someone who will probably maybe like actually do some more diligence, maybe have some governance, and also actually do the work as well. So I think that's kind of a trade-off that a founder has to make.
Just one small anecdote, because I completely agree. I always just tell founders, like, there's a lot of metadata in terms of how someone runs a diligence process. So even if the diligence process feels like a total colonoscopy and it's like super intense, just think that's the level of rigor that someone's going to bring when they read your board deck, when they step into the boardroom, when they're giving you advice on something. And so leaning in and like actually reading that data and appreciating it for what it is, I think is helpful.
Yeah, we used to run the program for 20th Century Fox, the film studio, before Disney bought them. And we had a startup we were looking at a deal with, and there were all these regulations related to consumer data and privacy and following laws. And the startup said, "Oh my God, you're going to make us follow all this." The other studio that we did a deal with didn't do it. And we said, "Do you want to be a big company? We're preparing you for prime time. You should be grateful that we're helping you get ready to be a scaled business." And they said, "Oh yeah, I guess you're right. It's pain, but you're right." And I think all of this stuff related to governance is, we're going to help you get ready for the big time and professionalize, and you should want that. And venture capitalists should have to say, well, if you don't want that, why would we fund you? It gets back to that, quick buck. Can I make a quick buck versus am I really trying to build something question?
And that is related to Susan's question here. Susan Winterberg is asking about third-party ratings and whether it's about governance or ESG. These are obviously completely standard practice in public markets, right? And in a sense, the later you are in your VC practice, the more you will have to think about them, because ultimately, again, as soon as you're looking at IPO, this will be the standard scrutinization of ESG. Is there space, or would that help if there were kind of stamps that a third-party rating agency, for lack of a better word, would provide, or is that A, not realistic, and B, possibly not helpful?
I think it all comes down to the quality of the stamps and the processes. And as we can see globally already, the amount of scrutiny that's being drawn to ESG ratings being done in public markets, and questioning the type of processes and procedures that are getting followed. In a lot of cases, it's a lot of bot scraping, right? It's not actually fundamental due diligence that is getting done that is resulting in these ratings. So it all comes back to, I think, the quality of those, who vets the raters, who, to the point, before, grants those groups the right to rate as well.
Great. It was partly my job to catch us up on the late incoming of the whole conference today. I do want to thank all of the 5 panelists today. It was fantastic to have you here and have all of your perspectives. Enrich this conversation enormously. Thank you so much for being candid and open and talking about what you are and what you're not doing and where you think the industry is moving. I'm looking forward to continuing the conversation. But now I'm very happy to introduce a in the middle keynote speech, so to speak. Ari Weinberg is joining us from KPMG. He's been working on topics of good governance and ESG for years, much longer than I even knew ESG was a thing, with a focus on private companies. I'm very happy to have you here today. I think you're here. Ari, if you just turn on your camera, we can spotlight you and hand over the floor to you.
Thank you very much. Let me bring up my screen here. Okay. Well, Johannes, thank you very much. I'd also like to thank Brown and Stanford and NASDAQ, Venture ESG, and First Close for inviting us to share today. I'm Ari Weinberg. I'm with the KPMG Board Leadership Center. I've been at KPMG for just over 10 years, focusing primarily on private company boards. So as you may know, private company boards, and not just venture capital-backed boards, are not necessarily very forthcoming with information about board structure and processes. But I'm going to share some highlights from past and ongoing survey work today. In our research, we get as granular as we can, but when we look across private company boards, from VC to family to private equity, the differences that we observe usually have less to do with size, stage, or ownership, but more to do with the stance that the director is taking on the board, whether they are a founder, an executive, an investment firm partner, or operating advisor, or an unaffiliated, independent, or outside director. And a lot of the tensions that emanate from VC-backed boards has to do with not only building the right board, but finding the right balance for these voices. So we're just wrapping up a nearly 600-person private company director survey across VC, PE, and family, and I'm happy to share some highlights from that and prior work in my comments today. So first of all, I think what everyone on this call probably already knows and understands, and that's why you either are a VC investing in VCs or being invested in by a VC, are the advantages of VC-led boards. I'd like to start with the industry knowledge in the boardroom. So obviously, many or most, and the foundation of venture capital is that people in industry, and obviously first the tech industry, wanted to bring their operational and strategic expertise and to help found and fund future entrepreneurs. There's also questions of alignment. There's also questions of alignment. The directors, through their capital providers, their VC funds have capital at risk. The compensation usually for the founder and senior executives, and in fact, most people throughout the company in options or stock grants have compensation that aligns with the long-term strategy. There's an ongoing dialogue with management, as many have discussed, sometimes daily discussions between founders and executives and board members. And the time horizon and the relative illiquidity of the investment forces a focus on strategy, value creation, and performance. And I'd just like to point out some of these observations are from a handbook that we put together with the National Association of Corporate Directors a few years ago called Governance in Investor-Owned Private Companies. So on the other side, a lot of these things have been touched upon earlier, but the challenges of VC-led boards obviously include limited partner return expectations, and obviously potentially the pressure at the VC firm to raise the next fund, investment firm and or founder dominance that comes up. More recently, we're seeing differences in ownership interests at the VC level. So whether it's VC, strategic, as Scott was mentioning earlier, pensions, foundations, and endowments, and also more recently, sovereign wealth funds that have longer term capital. Another challenge can be sort of portfolio to portfolio company business, so related party transactions, and that all of those together bring a question of blurred accountability at the VC board level. So blurred accountability allows for what I call F words to sneak in front of G words. You've heard a couple of those discussed already today. Founder-friendly terms coupled with frothy markets and FOMO on behalf of the VC firms can lead directly into some of the risk oversight challenges. Obviously, we're talking about governance immaturity. We see informal audit committees, limited non-financial controls, culture and tone of the top issues. These are usually the ones that turn into headlines. And one that was touched on, which sounds like there's work being done on this, is the overboarding of investment professionals. We hear this a lot from outside directors at portfolio companies who say, look, the investment professional who's on this board, and including their staff, just don't have the amount of time that we think they should be dedicating to oversight. So while I know about 75 to 80% of VC-backed companies tend to fail, that's in the model, there's business model and market failure, And then there's failure due to a lack of oversight and internal controls, which I know the next panel is going to address. So investors and founders should all be aligned in preventing these control failures, the types that invite regulatory scrutiny and scorn from capital providers. So how do we move to the most recent stage, punctuated by F words, to a steady state of G words, so governance, guidance, and guardrails? So this is some data from one of our past surveys called Closing the Gaps in Portfolio Company Board Effectiveness. And here what you're seeing is it's important to understand where directors themselves see opportunities in board oversight, improvement in board oversight. So in this study, we looked at attributes that make boards work and to what extent the directors were in agreement. So here we observed, and you'll see here, investment professionals, company executives, and outside directors. And we asked them, in which areas of the following do portfolio company boards need the most improvement? Investment professionals see significant opportunity in shaping board agendas to be forward-looking and focused on strategy. And this is obviously, it happens in public companies too, where the board meeting and the board time is focused on reviewing the quarter, reviewing, say, maybe some key relationships, customers, employees, et cetera, but not enough discussion within that inner sanctum of the boardroom on thinking about strategy and moving forward. So that is, it's key to building board agendas. I'd also like to point out here that we see the widest gaps between executives, outside directors, and investment professionals in the communication transparency with the board and management by controlling and non-controlling shareholders. So sort of who maybe on the cap table is reaching into management and sharing a view, but the board doesn't know that they're coming in, or who from the venture capital firm is working with the founder, but they're leaving other directors or potentially an independent chair outside of that conversation. The other gap you'll see, and it's no surprise here, is directors coming to board meetings prepared and having familiarized with themselves with pre-read. The company executives say there's a lot of room for improvement there. And of course, the outside directors say, well, we've got this. So in our survey, 31% of portfolio company executives said that the board meetings weren't meeting expectations for forward-looking discussions. Where is the company going, and how do we create value? Similarly, 42% of executives on portfolio company boards said their board composition didn't align with the company's future needs. So this is a part of the discussion that I wanted to bring up, and I know it was in the prior panel as well. But when we meet with VCs and talk about board composition, we bring up, and I'll bring it up in the next slide, we bring up a tool called the board matrix, which a lot of public company directors may be familiar with, maybe less so in the private company setting. But what does it take to build an effective portfolio company board? Leadership experience, interestingly enough, was seen as the most important attribute to building an effective board, followed by industry sector expertise, accounting and financial expertise, and controls. So the tool of building the board matrix takes a look at the qualifications and the experience and the diversity of the directors. This is just a sample, and I include 3 directors here. It could be 5 directors. It can be it should be the whole board, but really taking a look at what the directors bring to the table in terms of what they visit on the CEO. So how do you stack the board with people who add value to the company, perhaps help the executives tailor strategy or go to market, and even consider how to go public or time a sale? So in the VC perspective, I want to stress that this doesn't mean that building a matrix doesn't necessarily mean populating it with butts and seats. It's really about people and capabilities. And if the VC firm or the VC firm's partners or operating advisors can help bring some of these capabilities into the boardroom or into the founder and the CEO, that's another way to think about it. As you shift potentially towards going public, you will obviously need to fill these with people. So what's interesting is the discussion about building a board matrix can be between the founder and a lead investor, or if you have a lead independent director. But it really is an experience that helps the founder think about long-term strategy. I also bring up diversity. More recently, diversity has obviously been very much in focus for public company boards, so much so that NASDAQ-listed companies will be expected to disclose board diversity in the near future or explain publicly why they've chosen not to disclose the diversity of the board. So my inclusion of this here is to make sure that diversity is included in the discussion as a critical component of board composition. But it's not just composition, it's board leadership. To what extent does a founder or CEO need a strong board leader to help guide the company? I know this can be a challenge for small and growing portfolio company boards, but when is the right time to bring in an independent board leadership? And perhaps the best way to start is with bringing in an independent to lead a formal audit committee. Again, here in this slide, I'm highlighting the degrees of difference between executives, investors, and outside directors. So outside directors obviously over-index on the importance of independent directors or lead independent directors, and investment professionals very often say, we got this, it's not as important. So to close out, I'd like to share some early findings from our current survey, which is just wrapping up and includes several voices from venture capital-backed companies. Obviously, as the discussion that we're here today to have means that governance is back in focus for reasons that we've discussed earlier. Regulators are focused on it, whether the SEC comes out with anything or not is up for debate. And investors, namely limited partners, are focused on this. So in the current survey, founders and portfolio company executives told us that they see significant value in bringing in independence as a sounding board for the CEO. But not surprisingly, investment firms, as I just showed on the prior slide, under-indexed on this view. So there's a conversation to be had about how do we bring in the right level of outside voices to the inner sanctum of the board. Portfolio companies have strategy and risk management at the top of mind, with one investor writing in that they expect to see more rigor and discipline around board meetings. And I think the prior panel also mentioned that, that's the phase that we're in now. And hopefully we don't forget that as we move potentially back into a new phase of cheaper capital, although many don't see that coming anytime soon. Board diversity is still a top challenge in the VC industry based on the survey results that we're seeing. And though obviously many organizations are working diligently on tackling this. And lastly, portfolio company directors told us that they're moving to have significantly more engagement with employees to get a better understanding of the tone at the top of the organization, so the tone set by the senior executives, as well as the culture throughout the organization. So the question, it begs the question of to what extent were portfolio company boards willing to dig into some of these companies that made the headlines, dig in and understand what the culture of the organization was and potentially have prevented some of these governance failures. So with that, I'd like to conclude my remarks. Thank you and good luck to everyone on their governance journey within venture capital. I've shared here, and I know the slides will be shared following this, some information on the KPMG Board Leadership Center. And I wish you luck on the rest of your conference. Thank you very much for having me today.
Thank you so much, Ari. The findings from your recent survey are really interesting, and they tie in perfectly with our next panel, which will focus on designing, implementing, and monitoring internal controls at portfolio companies. This session will be moderated by Ed Zimmerman, who co-founded and chairs the tech group at Lowenstein Sandler, where he's been a growth company, startup, and venture lawyer for 30 years, and has been repeatedly ranked as a top emerging company and VC lawyer. Ed co-founded First Close Partners, which invests into venture funds owned and run by underrepresented managers. Welcome, Ed.
Thanks so much. I'll just say a few words, and then I'd like to ask the panelists to do quick intros of themselves, and we'll go into the topic. There's governance control and the accountability, particularly for portfolio companies of venture funds. These are companies that are not yet public. Some of them are working their way toward becoming public, and others are much, much earlier in their life cycle. And it is a challenge to think about how you implement controls, and at the same time, you don't necessarily have the capital to implement those controls. And we're going to hear some public and private perspectives on how to accomplish this. I also just want to make sure that in framing, this is an ESG discussion, E for environmental. S often gets left off the table. S is social impact. That includes, but is not limited to, diversity, equity, and inclusion. And as we're thinking about these controls, people all too often think about them in the context of accounting controls and regulatory compliance controls. And that's kind of bullshit. Because if ESG actually means anything, then what are your DEI controls, including the equitable component of DEI? What are your larger S controls? And I want to make sure that we're going to be talking about that in today's conversation, which I'm really looking forward to. Laureen, why don't we start with you? And can you give a little bit of your background, please?
Sure. Hi, everyone. Thank you, Ed. I'm Laureen Pendleton. Most recently, I have been a VC fund manager with Portfolio Rising America Fund 1 and 2, where we invest in underrepresented founders, and about to launch my own new fund. Been an investor initially as an angel investor turned VC for about a decade now. Thank you.
Terrific. LeBone?
Hello, everyone. LeBone Moses. For the past 20 years, I've actually been advising organizations, boards, and C-suite professionals. 17 of those years, primarily working with large-scale companies, Fortune 500. Overlapping that, the past 10 years, I have been an investor and an advisor for startups and venture capital firms. I also am launching and raising for a fund this year, and have a significant amount of experience with advising investors, currently in areas around technology, financial services, and healthcare industries.
Great. Stefan and then Laura.
Hey, everyone. I'm Stefan Tomlinson. I'm the CFO of Confluent. And by way of background, I've worked at companies at each stage of the growth curve in software, security, and internet. As CFO, I've worked at Series A through Series E companies. I've taken 3 companies public in 3 different decades and helped grow and scale those companies post-IPO. And I've served on multiple public company boards over the years, and I currently serve on the board and I chair the audit committee at Eventbrite.
And I'll wrap up for the panelists' intros. I'm Laura Blum. I'm the Chief Legal Officer at Momentive. You may know us as SurveyMonkey. We changed our name a little while ago. I have been here about 6 years. Before that, I was at LinkedIn as the head of corporate legal. Was involved in the IPOs for both companies, so was at both companies in both the private and public company phase. Before that, I was in private practice for 10 years as a corporate securities and governance lawyer. And also happened to be at LinkedIn when we made an investment in Confluent. So have that little overlap as well. But very excited to be here and join this esteemed panel.
Great. So let's jump right in, and then I'm going to pull back and give a couple of specific examples that we haven't yet talked about. What's the role the board plays? And in venture, as was said earlier, they're largely focused on VC investors on the board. What's the role the board plays in overseeing internal controls and governance?
So I think it's really important that the board understands the difference between the oversight and the management. The board's role is governance from a fiduciary standpoint. That means that the board plays a role in ensuring that the tone of the top, the right tone of the top, is in place, beginning with the CEO. One of the most important roles of the board is ensuring that the right CEO is in place. And that's part of the tone of the top from an internal control standpoint. It is also very important for the board to understand what internal controls are in place across the board in the company, but not to actually have their hands in creating those internal controls and managing those controls for the company.
Anyone want to add anything to that before Lorraine, it looked like you were about to jump in.
No, I mean, I think what she said is true. I think, the board has fiduciary responsibility to, manage the company in terms of, managing it, making sure the C-suite is doing what it's supposed to do at the benefit of the company, but not getting involved in the day-to-day operations of the organization. And then, internal controls are created, the board is not implementing that or, doing that, but would be a part of, establishing that these should be in existence. So yeah, that's what I was going to say.
Okay, great. So I'm going to mention a couple of companies that run the gamut, and I'm not talking about WeWork and FTX, which I know everyone wants to be talking about because they're enormous and they're current. I don't know how many of you followed Ubiome, which was backed by 8VC and Y Combinator and raised over $100 million. This was a crappy company. And by that, I mean that literally their product was you submitted a fecal sample, they would analyze it and produce a report. It was also a crappy company in that they turned a blind eye to compliance and pursued at all costs a path designed to bring in the greatest investment in their company. They bilked insurance providers with fraudulent reimbursement requests instead of an important, robust compliance program. I'm quoting the assistant US attorney when the DOJ went after them for fraud. And my understanding is that according to the FBI, since 2021, the two co-founders, who are a married couple and who relocated outside of the United States, are considered to be, quote, fugitives. Okay, so that's one example. And clearly there were oversight problems throughout. Another example would be a company called Juicero, which raised 100 million, which raised well over 100 million, I think it was $600 million from Kleiner Perkins and Thrive Capital, according to CB Insights. And according to the New York Times, Juicero shut down soon after it was determined that this several $100, $400 machine that made juice from packets, the machine itself created nothing that you couldn't recreate by just squeezing the packet with your hand. That's not a compliance issue. It's not a regulatory, it's not a fraud. Maybe it's a fraud issue. It's a we're not that swift issue, right? But there's still an oversight. And the last one I'll mention before we go on is, any of you know Chahal G and the company Radium One? In 2014, the board is going back and forth over email, and this is according to CNN, after he had pled guilty to domestic violence, but had gotten a slap on the wrist, a $500 fine, and months of probation. He was caught on video punching and kicking his domestic partner over 100 times, and the board did not replace him, and the video was kicked out of evidence. He later repeated this. That is, and their board email saying, "I'm so happy for you that this is behind you. Best as always, signed board member, for example, and these are venture investor board members. That is a complete abdication of responsibility. How would internal controls stop these three different things? Juicero, we're not that swift. Ubiome, we're going to commit fraud and go on the run. And Radium One, this guy beats up his intimate partner. What kind of internal controls would you as board members, would you as executives want to see in these case studies? And these are all, I've got links I can share to the articles, so I'm quoting things here.
I'm happy to start if that's okay, or sorry, Lavon, if you want. Okay.
No, go ahead.
Yeah, I mean, I think internal controls, I think as you started us off with, Ed, it's, it's something that some people think about as just this like vague thing that public companies have to do as a compliance measure. And the fact of the matter is when a company begins and they start to operate, they will, in lots of cases, naturally start putting in processes that actually are internal controls, even if they don't call them that. And I think your example of the CEO, abusing a domestic partner, something simple that could prevent is as simple as conducting background checks on your employees. So an example of that is you start to hire employees. One of the things you might do is talk about doing reference checking or background checking. Would that have caught this? Depends on when it happened, on what the records are. So just an example of something that companies early stage may not even consider an internal control, but they might put it in earlier than they would think about a broader internal control function. They might start thinking about things like background checks and reference checks on employees. Whether or not it would catch, if it's the founder and that person is in charge, different question. But that's one example. On some of the other examples, I don't want to take up too much time, but I think the point that I wanted to make is that an internal control may not even be thought of as an internal control and could pick this up pretty early on in a company's life cycle.
Yeah, one thing I would just say on top of that is for the other two companies outside of the domestic abuse horrible issue there, in the culture of compliance and tone at the top, even the earliest stage companies can have whistleblower hotlines established, and that can be a method by which rank and file employees who understand what's going on in the company that can identify fraudulent behavior or unethical behavior. It's the role of the board and the audit committee to ensure that employees can have a voice through the whistleblower hotline. So that's something that, as you and I had talked about this earlier, like a lot of earlier stage companies don't have the budget for, a broader SOX program or internal controls program, et cetera. There are some, very reasonably not expensive ways to go off and start putting in some of these things like a whistleblower hotline.
Yeah, I would agree with that. I think just going back to tone at the top, that includes the executive team, but that also includes your policies and procedures and your processes that govern the internal workings of the company. And I think things like a whistleblower policy, code of ethics, but also what is your process for removing senior executives? Similar to what's the process for hiring them. That needs to be in place. And a lot of times with startup companies, things are moving so fast that the company gets built before the infrastructure of the company gets built. And so you see these companies that appear extremely successful with no structure around people, processes, and technology. I'm from the Big Four world. I spent 10 years in Big Four. So that's all we talked about. People, process, technology, right? And with startup companies, you see this hockey stick growth with no infrastructure underneath around people, process, technology. And so when something happens, what are decisions being based on if there's no policy? if there's no process, how are you deciding that it's time to fire the CEO? Is it based on whether or not you went golfing, or you still like them, or right? You have play dates with your kids. What is your decision making? Or is it how much money you're making? What is the decision making process? And so that is part of what I would have liked to see with the was it Radio One? I wasn't familiar with the case, but what I would have liked to see was that the board had a process in place for not just how to hire, but how to remove the CEO. What are the criteria that means you're out of here? And ethics, I would expect to be part of that criteria. So that's one. On the first example, internal controls over financial reporting should have helped catch that, right? Because there are things that indicate fraud. Controls can be preventative or detective. So it could be that there are checks in the system, or is it Stefan? To Stefan's point, it could have been that you had a monitoring process in place, something internally that maybe wasn't an expensive system, but that you put in place so that an employee knew if I notice something wrong while I'm working, I can call it out through a whistleblower process. So I'll say that on that one. And then on Juicera, I remember this case, and my take on this is that while the decision to keep selling the device might have been unethical because they knew that you didn't need the device to squeeze the juice out into your cup, the reality is that the fallout from that was really that there wasn't a process in place in the company to help them pivot. So when the device that they had sold everyone on for all this money no longer worked for them, they didn't realize they didn't have a pathway or a process that would take them into a different direction. They just got stuck. And so again, like to your point, Ed, controls don't have to be financial, right? But what controls do you have in your process that even tell you it's time to pivot your strategy and put something different out in the market based on the product you have?
And I may not have a problem with Juicero selling a machine that no one needs, because if we stopped selling products that weren't good or that people didn't need, we'd have like a massive shutdown, right? That's not necessarily the bar. There should have been some more controls in place there. But I also love the point about doing the background check, Laura. You're right. The background check would definitely not have stopped them from investing in Radium One. However, 2 years later, when he was sentenced to jail for actually doing the exact same thing to his next domestic partner at another venture-backed company, maybe that would have stopped it. But I'm sure that they knew about it, because you can still Google it, even though he spent a lot of money on reputation defense online. If you look at other examples, like Zenefits had a scandal. The founder of Zenefits has gone on to start a new company in a very similar segment of the market. That new company has raised $700 million from some of the investors from company one, because we give people a second chance. I'm not sure that that's necessary. I think that there is a limit, and that there are certain descriptors that apply to the people who get those kinds of amazing second chances. What
Adam Newman, another example.
I'm sorry.
Newman. WeWork, Adam Newman.
Adam Newman is another example. Yes.
Very high profile one.
Yes, it's a great example. And Adam Newman, I think in the quarter in which he received funding for his new company, Adam Newman received more funding that quarter than all women and all Black founders combined for the quarter. So what is the accountability at the venture fund level? How does the investment committee at the venture fund level, and I'm an LP, right? So We mentioned First Close Partners. Through First Close, where we have an 8-member investment committee, we've invested in over 100 venture capital funds owned and operated by underrepresented venture investors across the globe. When we think that there's an integrity issue or something, we discuss that with our full IC. How do we think about the kinds of controls that a venture fund itself, because presumably the partner greenlighting the investment is taking it to a committee? Are VCs being responsible stewards of capital in a way that makes sense when they are investing in Chahal's next company, when they're investing in the founder of Zenefit's next company? And how should we be thinking about that from a governance, but from a more broadly ESG perspective? And what kinds of controls should we expect venture investors themselves to implement?
I mean, I'll jump in. I mean, I think it's all part of diligence, really. I mean, I think, whether you're looking at investing in a company or investing in a fund manager, you should be focused on diligence. And one of them should be that person's background, and that person's, just their reputation is really important. And so, people who are investing in, companies, the investors should be an investment committee and doing proper due diligence. And so that should have been flagged. That should be flagged if he were to go off and in the domestic violence case, go off and start another company and is seeking capital, immediately should be, flagged or, discussed, and just say, is this someone we want to be attached to also? And from the VC firm's reputational risk as well, like, do you want to be associated with someone like that? And so I think, diligence is really key. And then having the courage to say, I don't care how, even if it's an interesting company, a business model, there's a lot of people interested in it, walk away from the deal.
And when you talk about walking away from the deal, what kinds of things can you implement to ensure that people inside the company are actually able to feel like they can be heard when they want to lodge a complaint? Because in these stories, Zenefits had a process for making sure that only licensed brokers spoke to clients about their benefits, but young and inexperienced managers did little to enforce it. Again, that's not me with conjecture. I don't know that that's accurate. All I know is I'm quoting the press on that.
I mean, well, so there, I think a couple of things, you should have, every company, and it doesn't necessarily have to, even a, startup, early stage startup, doesn't necessarily require a ton of money, but, set up, kind of a, policy for employees, which includes, code of conduct. And there should be in there, first of all, and it doesn't exempt the C-suite. C-suite, everyone who's an employee of the company, which is CEO, C-suite are employees of the company, even if they're founders, they have to adhere to that. And then if they don't, there should be a whole process where, they're, can be removed. Obviously, they can defend themselves, but a process, and the board will have oversight of that. So that's number one. And every employee should, be a part of that, or just know about that. So I'd say that that's the number one thing. And then have also a process where employees can there could be a whistleblower, or have a kind of an anonymous tip that they can give to the board. And again, that can be implemented for an early stage company. There are third-party companies that exist that allow you to do that. So those are the kind of checks and balances that you have for employees, so that that they can disclose this information.
And I think, sorry, I was going to say, I think those points that Lorraine made are really good. And I hate to sound like a broken record, but if you go, some of these things may already exist in some form. And so it may, like a company may actually have processes that they're doing informally. And it's not really hard to actually put them in place as a more formal policy or guideline or whatever you want to call it. And it's about making sure people understand and not think of things like internal controls as bad news or a scary thing, but more like, how can we do this? How can we make this a good thing for the company so that we make better products? We know when we need to pivot, we can catch problems before they start. And so I think that's all of these things that we're talking about that may exist at some stage earlier than people think they do. You really can take advantage of that and build off of it. So I think sometimes people are so scared of the quote unquote compliance piece or whatever it is, and it isn't as scary as you think.
And I would also say encouraging the trainings and information sharing with employees. A lot of times employees do have the perception when a policy comes out, oh, this is bad, right? So the whistleblower policy comes out and everyone runs from it because they're not going to care. I don't want the repercussions of being a whistleblower. But if management introduces that policy and process in a positive way and helps employees understand that there's not repercussions for this, it's anonymous, what have you, this is part of our culture, I do think that makes employees feel more comfortable to bubble things up as necessary.
So one of the ways that we might be bubbling these things up is, and if you think about the different stages, right? A Series A company, a seed stage company, or like a Series E, growth stage has raised $500 million plus in funding company. It is important and valuable to design policies. I don't think you necessarily need a policy when someone is caught on film in domestic partner abuse. I think having the board, for instance, actually interact with management other than the founders, management other than the C-suite, just having them enter the meeting so that there is some line of sight and rapport, that seems to create the opportunity so that someone could potentially stay behind and say, okay, I do have something I want to talk to an outside board member about. What other things do you see? And Stefan, I see that you unmuted yourself. I don't know if you wanted to chime in here.
Yeah, having broader representation at board meetings, like having exec staff, especially for earlier stage companies, attend those meetings. That has been a kind of a de facto standard for the companies that I've worked at. And then in conjunction with the board meeting itself, oftentimes there could be a board dinner the night before, or in other cases, the day of the board meeting, the board would stick around for like an extra hour and have an extended leadership team kind of cocktail mixer or gathering. And that actually facilitates accessibility, and it shows that the board is approachable. And I think those softer things that really don't cost very much money, but have a very large impact relative to establishing a broader relationship are things that I've seen work in the past and help with the overall communications.
Yeah, I agree with that also. And I think there's an elephant in the room we often don't talk about, which is the fact that most CEOs are in close relation to their board members. We don't have enough independent directors sitting on these boards to be able to have an unbiased, unconnected opinion and judgment. And I think that is an elephant in the room, because what ends up happening is that even after I've heard all this, but you're my guy, but I've known her for years. And I think it's very realistic. It's not we see this all the time. And what having an independent director does, as well as having some of these policies and procedures in place, is if you're really following your process, it takes the bias out. If you are independent to the relationships on the board, it's a lot easier for you to say, this is an ethical issue and we need to talk about it, right? Let's see the video. If this really happened, the CEO needs to be removed because there's reputational risk for the company, because this impacts our stakeholders, right? I think that's a big elephant in the room. We don't address it enough.
So I love that point, and I want to tie together your point and Stefan's, and there are two comments in the Q&A that also I think tie into this. I understand how a senior exec is going to go to an independent board member after they have broken bread, or, you know, if you're low carb, steak at a board dinner. And I also understand with an accounting problem that they're seeing, or a compliance problem. And I certainly understand how a board member might go to Laura in her first week as the new general counsel of a growth equity backed company, because a startup wouldn't be able to necessarily afford her, but a growth equity backed company might, and say, I have some concerns about regulatory and compliance, and I'd love to have a one-on-one privileged conversation to get a download, right? That makes sense. Most boards in venture lack diversity. A lot of the problems are problems that are a lot of the cultural problems, and a lot of things that, you know, lead to bigger down spirals are not necessarily an accounting issue. How do you deal with, we have culture issues, we have misogyny issues, or homophobia issues, or race issues, and we've got a 4 or 5 person board. It is all straight male, and I maybe have been in proximity with them, but I haven't gotten the vibe, I haven't gotten the sense that this board is going to be particularly responsive to this set of concerns. What controls can a company put in place to preempt that, or to create a greater opportunity to be more forthcoming about reporting?
So I'm happy to start and love to hear what others have to say. And I might not start directly with controls per se, but something that I think works well is building something that we've tried to do, and we are a public company, but you could do it later. You could do it as a private company, is in our reporting out to our board. We have metrics that we look at, and this is like just one piece of it. We have metrics that we look at in terms of promotions, raises, hiring, all of that, everything having to do with employment, that we just report out, just like we report out our sales metrics, just like we report out on our security metrics, the audit committee. It becomes part of the regular cadence, and there are controls associated with it so that those metrics are correct. So that's like the controls piece of it. But I think having the requirement, it might not be a legal requirement or some other kind of requirement, but making it a part of the requirement of what you report on to your management team and to your board every quarter, or however often you do it, that then requires you to put the controls in to make sure you get the information right. And so you see that you're asking about big, broad questions about preventing misogyny and homophobia. And like, I wish I had all of the answers, but I think a starting point is trying to understand culturally as a company, there are things that certain companies, including mine, believe are important enough to measure. They are just as important as the other metrics that we measure. So if you make it a requirement that you measure and report on those metrics, you will put in controls to ensure that you get them right. So that's sort of a starting point of how you create the requirements and then drive the controls. So it's not a complete answer to your question, but that's just something that I think works fairly well.
It's a great part of an answer. Absolutely. And so metrics and reporting back to your entire team, not just the board, because that establishes.
And publicly, like if you can convince your team to put out public goals that you have to tell people where you are. You might not make them. That can be a forcing function as well. And that's something that I think works really well. And if you don't make it, that's okay. You can tell people if it made it, and you're going to work harder to get there next time.
I also think with the things like whistleblower policies, you can have built into that controls that require that if a certain level of issue arises, it needs to be made known to the board. And that's not just in the people. So that happens a lot of times on the business side. You know, if there is a cyber breach in the company, management doesn't just handle it in a huddle and then act like nothing happened. That ends up on a board report that gets reported. Why? Because of the criticality of the issue. And those levels can also be implemented as it relates to employee concerns. So if a concern bubbles up from the ground because there's a particular leader that or a particular department that's having challenges with racism or misogyny, what have you, at a certain level, again, I really believe in having these processes in place. At a certain level, it should be required that that issue be bubbled up to the board.
And what about accounting controls? And often in smaller companies, you don't have a top audit firm. You don't have 6 people on your accounting team. You might have 1 or 2 or even 3 people, and someone might not be doing a great job at what they're doing. What have you seen work in those contexts? And Stefan, I think you're the only CFO on. I don't know if you want to start with this one.
Well, for super early stage companies that have maybe a 2 or 3 person accounting department and they don't even have like FP&A yet. What I've lived in those companies before, and so what I've seen work is even if the company can't afford a big 4 firm, the next level down firms are still very competent in having a good outside advisor to come in and be helpful around setting up processes, systems, and controls. Being stage appropriate is super important, and having advised companies of that stage as well, in addition to working at those size of companies, I think that external third party help is super important to provide that right framework, and it can be done again in a relatively low cost manner. So I would suggest that.
Yeah.
Sorry.
Go ahead.
I was just going to say I've had situations with clients who didn't have the resources to implement a robust accounting team. Typically, to Stefan's point, you can your auditor does not have to be from the Big 4. There are small audit firms that would gladly perform an audit at a lower cost, but you can also implement monitoring controls where you can't put in a robust system, where you can't hire someone. You can put in a monitoring control that helps reduce the risk and help segregate duties. There are a lot of things you can do, but I do think the point about making it specific to the stage that you're in, I can't remember the phrase you used, but it was really good. The stage that your company is in is really key, because you need to implement what's right for where you are.
Yeah, and the National Venture Capital Association, which created some model legal documents for venture deals, and about, 15 years ago, I co-chaired one of the committees that was working on these documents, and we've been involved for many years, but they now publish data over how used various terms are. And in the investor rights agreement, there's an information right which requires the company report annual audited financial statements. And the data is disappointing. At Series Seed, only about a third of deals had that requirement, meaning 2/3 it was negotiated out or just omitted. At Series A, less than half the deals in 2021 had that provision. Series B, it was just over 70%, Series C, 80%, and it only hits 90% at Series E. Also, there are declines year over year in how often that term is actually in the document, how often the annual audit is required between 2016 and 2021. And those declines mirror an uptick in the amount of funding on average at each of those stages. So we're putting more, the venture industry is putting more money to work and being more lax about requiring audits. The stats on how often the information rights include an annual capitalization table are worse. It's 11% at seed, 13.5% at Series A, meaning 86.5% of the time, a Series A company is not required to provide an annual cap table to its major investors. And when you think about the fiduciary duties that the venture investors themselves or the growth investors themselves have, because it's only 18.7% of the time it's for Series E companies. So it's still less than a fifth of the time in companies that have raised hundreds of millions of dollars to get to a Series E round. And they looked at 200,000 venture transactions to get these stats. My recommendation as a lawyer doing venture deals for 30 plus years and teaching venture in the MBA program at Columbia, you want the audit firm, ask for the audit. Founders, you don't, why would you want the liability of getting the financial statements wrong? Be able to blame the outside auditor. What are you thinking? So what are—
I didn't get that. Could you try again?
What are other things like that where you are seeing the opportunity to have that outside help? And yes, it's pain to have an audit. And I understand that if you've raised $8 million, you don't want to spend $100,000 on accounting or whatever the number is, but you do. And I'm just wondering, where else you see the opportunity for these controls that are going to build value, because when it's time to sell your company, having audited financials is a really great and important thing. Having auditable financials is also essential. Knowing what's on your cap table, you're going to be giving a representation and warranty to any seller, any underwriter in an IPO about the sanctity of your cap table, right? So handing out those annual statements and saying, yep, this is it. Take a look. If something's missing, let's talk. What other things like that? Go ahead, Maureen.
Yeah, I mean, before we say other, kind of internal controls that can be implemented, I just think, companies should be viewing this is an integral part of their business operations, and it generates business value for the company. And so, yes, it shouldn't be seen as, oh, I've got to do this. This is a pain. It's really like, okay, we're going to do this the right way. This is an integral part of how we do business. It's going to increase our business value so that when we go out the next round for investors, I didn't know about those stats, but I'm not surprised. It shows that you're different from other companies, and it's a differentiator, I think. And so I think there has to be this mindset shift for companies, specifically private companies, that this is like, the cost of doing business. This is actually a good thing. It's going to enhance the value of your company. It was interesting when I was prepping for this, I was reading something about, another internal control, which was actually kind of made sense when I thought about it. Your T&E audit. They said companies should have, a T&E audit. And they said, kind of the best in class companies, 88% of the best class companies have a T&E audit, because actually it's an indicator of the health of the company and these internal audits. So imagine, you've got an executive, they're out and they're spending, and there's no someone, watching over their expenditures, and that's not really a healthy company. So I thought that was really interesting. So that's one example. There should be, cybersecurity, breach. How do you prevent cybersecurity? What if there's a breach? How do you deal with that? That should be an internal control. So there's, and there's other internal controls, but, all of these, I guess, go back to my original statement of, it's a great thing for the company. It's going to, create better business value. It's a part of, you doing business, and is an imperative for you operating a healthy company.
So I absolutely agree with that. It's interesting you said cybersecurity. I don't know if you all remember the Colonial Pipeline breach. They had a ransomware attack, and the board proactively made a decision to shut down the 5,500 miles of pipe, which covered like 45% of East Coast fuel, right? Well, the board made that decision because, and this is a big company, right? The board made that decision because they did not know their infrastructure well enough to be able to gauge the risk of the cyber attackers having access to more pipeline. So when they looked at the situation, they actually made a decision to shut down and impact more customers than they probably needed to, simply because they didn't understand their own infrastructure well enough to see where to isolate the risk and say, this is where the attack happened. This is what they would have access to. This is what they would not have access to. So we don't need to shut it down, right? So the safer thing to do was shut everything down, right? So again, internal controls requires you to understand your company. It requires you to understand your infrastructure, right? And when you put cyber controls in place, you have to know where your data is. You have to know where your systems sit. You have to know how systems information and resources flow. And if you don't, you get into these situations. So that's a large company that faced that and impacted millions of stakeholders, probably unnecessarily, right? Because if they understood their infrastructure, they might not have had to shut everything down. Imagine what smaller companies are facing. The other thing I want to say, I think another thing we don't talk about often enough is that a lot of founders are great at what they do. They're experts at, what their company does, their invention, but they're not necessarily experts in law, in accounting, in finance. And so if you don't bring the right third parties on early enough, you will be incurring an unnecessary risk for your company, financial risk, reputational risk, legal risk. And unless you're just banking on continually filing bankruptcy, I don't know what the plan is, right? But the reality is that if you don't have that expertise, you're going to find yourself in a situation where you've taken on more risk than you can handle down the line.
So let's you mentioned legal. Let's talk about the regulatory and compliance piece. We've talked about accounting. Obviously, there's tax compliance, which people seem to get wrong frequently. And I've been spending lots of time on internal investigations relating to tax foul-ups. But some businesses are otherwise regulated. Some businesses might be regulated if they treat things one way and might not if they treat things another way. And that judgment call becomes a really big issue. How do you deal with that, where something is sort of on the edge of, maybe we are regulated, maybe we aren't, and how we're moving toward that goal?
I can take it with one particular issue, which is privacy. Very important to both of the companies I've been in-house at, because we deal with a lot of data, and privacy is really complicated. And whether you are regulated and who you are regulated by is often up for debate. And one country might think they regulate you, and you might take the position that they do not, and another one does. So I think from a decision-making perspective, it's really important that the company and the board be aware of what the potential areas are and make an informed decision. If there is a debate about whether the regulation applies, the leadership and board has to understand that somebody could disagree with you. And what does that mean? So that might seem very, very obvious, but I think a lot of times people skip that step and they just take the position without making sure people understand that you're taking a position that might not be agreed upon by the relevant regulators. So there could be a risk that they come and take a different position, and then you find yourself having to defend something that you didn't explain to begin with. And so the primary thing from my perspective that you need to do first is understand if there's a debate, that people need to understand why there is a debate and determine a recommendation and a path forward and make sure there's buy-in on that.
Yeah, and I think that that's a pervasive issue across venture-backed companies, because often you're challenging a business model, and these things aren't necessarily the most obvious things, but things like, if you're LegalZoom, are you engaged in the unauthorized practice of law? And you don't have the good fortune of a federal regulator. You've got every state bar association in America, for instance. And there are lawsuits, and you've got private parties and consent decrees. So looking at those kinds of things and making sure that people do have an understanding of the changing guidelines. We saw this with Airbnb as they went through various local laws all over the place, gotten heat in some places and other places no. Is there a reporting capability or a control that you've seen people put in place when a company has 20, 40, 50, 100 people? Because that's when it's like, it's not that cost effective to do, but it's going to be a real problem if you don't do it, right? How do you run that up the flagpole? And this goes back to Vivek's comment in the Q&A about incentives are not aligned to report. You don't get rewarded for it.
Yeah, when I think about the specific places I've been, the areas that I can think of where this comes up, and I go back to kind of privacy, because that's one that's very near and dear to my heart. Something that comes up often is customer service, for example. I'm just going to give you an anecdotal example of where this comes up sometimes and how you can control it. Somebody's having a problem with whatever tool we're allowing them to use, and they reach out to customer support, and customer support wants to, we have the ability for people to, sort of step into the shoes of the customer and take over the account. Very, very common. Sometimes that can have one issue that is problematic from a privacy perspective and could give people access to more information than we would like them to have, is if that tool is used outside of customer support. Or used in different ways from a product development perspective where there's experimentation going on. And I've seen this happen in a couple of different places. And how do you, so again, just using this as one simple example of how do you put in, and you could think of other examples that are kind of similar, where there's a tool that's used for one thing, where if you use it for something else, it violates a regulation of some sort. And how do you make sure that people aren't abusing the tools that you have, and how do you even make sure people understand that might be a problem? And I think when I think about it, it goes back to what Levon said early on about training, where you have to make sure people are educated in what your product is and what you allow it to do, so that they can recognize if there is a problem. And the controls that we've put in place it's very simple. It's very basic. When people come on board, they have to do their product training. They have to do their privacy training, and their annual updates are sometimes every other year updates to these things where you have to do it. And then you have to give people the ability to explain if something is being misused without, again, it goes back to whether through a whistleblower or some other notification policy so that people don't feel like, oh gosh, if I tell people, like sometimes people make a mistake and you want them to be able to tell you, I did this way, but I think after my training, that might've been the wrong thing. You have to give them the tool to report it. And it, like I said, I'm using this example of because I've seen this happen a couple of times where we've been lucky enough for people to tell us, oh, I didn't realize that when I did this for this purpose, it actually could be problematic because it was designed for this other purpose. And so it all comes down to making sure you're taking responsibility for what you're asking people to do and training them on what it means. So really kind of a long example, but
that's great. And last question is, Greg Tarr put a question in the Q&A asking about independent board members and recruiting them and giving them true independence. You really need them in a market where you're doing down rounds or insider-led rounds, or even where you're looking to compensate a founder or do, secondary led by the company or an internal investigation. Often people wait way too long, right? You'll agree on a 2-2-1 board, two common seats, 2 preferred investor seats, and 1 independent, and no one gets the independent. So how do you best recruit and give true independence to an independent board member? Laureen, I see you lurching forward.
Well, I mean, I think, you want to try to do that as soon as possible. When you're forming the board, have a seat where that you have independent, board members. I think as soon as you can for a private company. I mean, I'm speaking like for private companies, and I think you touched on, now I think, with the VC industry the way it is and funding, now more than ever, I think it's going to be really important. So just as soon as I think companies need to do sooner rather than later, and it's even more of a, kind of an incentive to do so now.
Yeah, I also think you need to be intentional. It's very important to be intentional in order to go outside of what may be your known networks and find the right board member. Understanding the presentation that was given just before this was absolutely phenomenal. Understanding what you have and versus what you need on your board. What is your criteria? And being very intentional as you select your independent directors. One of the reasons that we see, a significant amount of boards who don't have independent directors is because of the effort that it would take. It's easy to say you're the lead investor. Here's your seat. Oh, you're my friend from years back. Here's the independent seat. We see it all the time, right? It takes a level of intentionality. It also takes a level of intentionality to diversify your board, to make sure that you are identifying talent from diverse areas, diverse ethnicities, diverse industries. It requires intentionality.
Yeah, and these are great answers. I'm also adding 2 links in the chat. One is Black Women on Boards, and the other is Him for Her. And Merlene Santil, who wanted to be here today and is ringing the bell at NASDAQ instead, who started Black Women on Boards. Because we know that more than 98% of the private equity, including venture capital, is not run by underrepresented managers. Your independent seat is an important opportunity for diversity, equity, and inclusion, which is part of that S in the ESG, and also part of what should help enable you to avoid situations where people don't feel comfortable reporting some of the social issues that we discussed to the board members. And often it's great to start by having someone serve as an advisor for a small equity grant as a pay for it before you commit to it kind of relationship, and see if they show up. So I think that is the time that we have for this, and I really appreciate the opportunity to discuss governance and controls and ESG with you folks. And First Close Partners is happy to team up with Brown and Stanford, where coincidentally I happen to have kids at each place, although that was purely a coincidence. And NASDAQ and Johannes Leonard and his group to bring this together. So I don't know, Kristen, whether you're coming on to say a few parting words, or Banu.
Actually, you were going to say a few parting words, and then Johannes was going to close us out, Ed.
Excellent. Okay. So the last thing that I will add is, I sit in a couple of different seats because I'm an LP investing in funds. My day job is I'm a partner at a law firm running an emerging companies and venture practice at Lowenstein Sandler, where we spend a lot of time guiding boardrooms and helping people think through interested director transactions, but also doing internal investigations when things have gone wrong, and selling companies and finding stuff in diligence. It's really important to make sure that you're getting good disclosure along the way. I like the ideas of, just to wrap a few things from the conversation we've just had, of doing the reporting, because to the extent that you are providing stats, you're showing people what's important, you're creating accountability, and hopefully working to improve the stats. We certainly understand that it is a more cost-constrained environment than it was for venture-backed companies a year or 2 years ago. But the accounting stuff really catches up with you. Some of the legal compliance stuff can as well. And it is impossible to take an organization with 200, 300, 400 or more people and suddenly start to bring diversity, equity, and inclusion into that organization. It has to be designed at the earliest stages. It becomes really hard and really slow moving if you try to do it late in the day. So thank you all, and Johannes, over to you.
Great. Yeah, thank you so much, Ed, for moderating, and for the panelists for the last conversation. I always say I'm completely out of my depth talking about startups and tech companies. So I'm very grateful to having learned more about what good governance looks like. I wanted to say a handful of words. I'm not going to keep us for much longer, on more general observations, explicitly also comparing what's happening and what we've been talking about today between the US and Europe, which again, that's often one of the forgotten differences that are important to think through, and then an overall idea of where we are and where we're moving. There's a general difference to be understood, which is one in terms of regulation, that is driving at least the investors' practices when it comes to both governance, but also ESG more broadly, where Europe is very solidly on one trajectory, and that is solid regulation being in place. We're moving closer to actually practically embracing that. And that comes with a lot of disclosure. That comes with a lot of the things that Ed just mentioned around KPIs. We're measuring and we're counting, and that means accountability is going to be much, much improved going forward. Teresa from KfW Capital out of Germany shared a lot about what that means from an LP perspective. And we're seeing on a day-to-day basis that that is one of the major driving factors that pushes VC to embrace not only these disclosures and metrics, because that is going to be required regulatorily, but also practices that include a lot of best practice around good governance, right? And then Teresa and her colleagues at different funds, different LPs in Europe come in and actually check up on them. I think the ecosystem there is best to be understood as a regulator that sets boundaries of what is happening, and then the LPs, which in many cases, and that is one of the major differences as well, the LPs driving the ecosystem in Europe are state funds. So Teresa works ultimately with taxpayers' money in Germany, and her equivalents in the EU countries as well as in the UK are mostly the big anchor LPs for all VCs there. And that comes with a different type of incentive system. And I think that is one of the reasons why we have seen way fewer problems, both when it comes to governance and ESG integration in the tech ecosystem generally in Europe. And I think that gap might widen even more. Well, by the way, the unicorn count, if that is one of the other ways of thinking about how well venture capital and tech is doing, Europe has been catching up dramatically. So it's not that we're kind of cutting these companies off from being wild and growing massively. There's just a possibly too tame of a regulatory approach to this, which might or might not bite us in the near future. So the LPs are ultimately the police that make sure that the regulation is in place, and also focus not only on the disclosures, but also on the practices and their due diligence. And I think that movement is now cutting through the whole ecosystem down to the portfolio company level, which are implicated in a lot of the disclosure requirements around the G, but more broadly around ESG. And that big push from the top down hasn't happened in the US. And I think again, that is one explanatory factor of why most of these quote unquote scandals and implosions around G problems, but also other problems from FTX to WeWork have happened here, right? It is much more self-enforcing what's been happening here. The ecosystem is much more driven on FOMO than it is in Europe. And what we've heard in the panel I moderated, I think the tendency and what we're seeing at the moment happening at the SEC might not actually shoot down to venture capital as much as it could. The SEC is investigating some venture capital firms at the moment around the FTX conversations, but several of the panelists said they're not exactly confident that this is actually going to put regulation in place that is even just a little bit comparable to what we have in Europe. So the baseline is fundamentally different. What we are seeing, and what we are also seeing, I'm seeing in my daily practice, working with VC funds and LPs around the world, including a lot with Americans, is lots of folks do want to change. They do want to build companies that are, as Scott said earlier, sustainable for decades to come, rather than just the quick shot, taking money out, selling, and that's it. They made enough. They did what they were supposed to be doing. Building generational companies. I think a new generation of employees in startups, founders of startups, employees in VCs and employees in LPs have been shown to come with a different value system. Now that tech has grown up or is growing up, I think without pushing too much into the hands of the next generations to come, I think the ultimate ecosystem is changing in terms of where their values sit. And we're seeing that in the GP and LP ecosystem in the US as well. While the top-down enforcement is lacking to the extent that Europe has got that in place already, I think there's a lot of bottom-up. We care about this, and we want to continue building companies that not only are world-mark leaders, but that are also generationally changing and solving real problems. And that is, I think, a hope that we can have across the ecosystem and across these issues that we've been seeing bubbling up, and will likely continue seeing bubbling up when it comes to the non-existent good governance practices that some tech companies have, some VCs don't, or very inadequately enforce and check, and some LPs have very little power of changing, or have had very little power of changing at the moment. So I think overall the ecosystem and these conversations that we're having today, which over the course of the last 3 hours had more than 100 people listening in and speaking, which is enormous and a very good sign. The ecosystem overall has caught on that there are some problems that we need to put our finger on. And I hope for many of you today, this was one step of not only understanding what's been happening and what we can do about this, but also looking forward to embracing the change of practice and the change of how you're going about your investments and how you're going about your LP investments in the future. The ecosystem is moving in a clear direction overall, and I think there's a lot of hope that with the push in all the different geographies of both consumer taste changing, employees in all the different setups that we've been discussing today, changing of how much they care about values, which include good governance and include particularly also one of the focus points that we've returned again and again to today, which is the complete lack of diversity across many parts of the ecosystem. And not last but not least, many of the VCs have pointed out the market has changed. The FOMO aspect that has been driving people, particularly in 2020, 21, 22, to write checks enormously quickly. And the Financial Times had a great article about this not too long ago. Is anyone still doing due diligence? I think that with the implosion of FTX as the very last nail to that coffin, that time is over. So overall, I think this conversation today showed very clearly there's many people in the ecosystem, with or without regulation being in place, that care and that are already doing things quite different from what we've seen some VCs and LPs do in the past, and that are more and more engaged of doing even more going forward. So I hope you learned as much as I did today. I want to thank all of the organizers, sponsors, partners, and most importantly, everyone that shared their opinions and expertise and wisdom with us today. And I'm looking forward to more of these conversations going forward.